Morning, everybody. Looks like our rate of flow into the webinar today has started to slow and taper off. So let's get started. Um, by way of introductions, my name is Sydney Burgess. I'm the Assistant Division Chief at the California Air Resources Board. I really want to thank you all for joining us. This is our second public workshop on the implementation of the regulatory package for Senate Bills 253, 261, and Senate Bill 219, which, as you may recall, we affectionately refer to as the 200s. Overall, this effort will help ensure that investors and stakeholders have clear and consistent information about the climate impacts and risks related to companies and corporations who do business in California. Really appreciate your engagement both today, as well as the numerous conversations we've had with all of you in the lead up to today, and I'm sure we'll be having in the future. It's really critical as we're shaping the implementation efforts associated with this package of legislation. So in terms of expectations, today we're planning on presenting our progress since the previous workshop. We'll outline the implementation of the statutes and offer further guidance on reporting requirements for potentially covered entities. If this is your first time engaging with our rulemaking process on this particular package of legislation, I would encourage you to watch the recording of our main workshop, as it may provide some helpful context to the updates we're going to deliver today. In addition to the main workshop, we've been working to get additional materials out to you to help with your planning around how to comply with this legislative direction. So that includes an enforcement notice that was issued in December 2024 related to reporting on scope 1 and 2 emissions in the context of SB 253, and an FAQ that addressed a number of questions related to implementation of both SB 253 and 261. So today's presentation really picks up where that work has left off, and today is intended to help resolve outstanding issues related to this initial implementation of the 200s. So again, really welcome your input and engagement during this process. I do want to be sure to level set some expectations, though. Our climate disclosure email and my work email have been inundated with asks for one-on-one meetings, so know that we're doing our best to keep up. We want to hear from you, but please be patient. Also, as part of today's workshop, we're going to open a public docket for written comments so that you have multiple options to provide input. Go to the next slide, please. I want to get out of the way a little housekeeping and workshop logistics. As a reminder, this meeting is being recorded and all workshop materials are available at the link shown on the slide. Today's public workshop is being held fully remotely via Zoom. You will be able to raise your hand in Zoom and speak during the public comment period. When it's your turn, the host will ask to unmute you. After you push the unmute button, you may begin to speak. Given the number of folks that have joined us today, we will be once again adhering to a 2-minute comment limit. And again, there's other opportunities to contact us beyond today's workshop. So as always, feel free to reach out to climatedisclosure@arb.ca.gov. For transparency, we do post materials received through that email address to our website as well. Next slide, please. We're going to start the workshop with a quick review on the background of the 200s reporting programs. Then we'll move to sharing the latest progress on regulation development and implementation, and answering the who, what, how, and when of this regulatory package. So the presentation includes updated definitional concepts for covered and exempted entities, and an initial staff concept for the fee regulation, which was authorized by legislation and is intended to fund the implementation of these programs, as well as discuss further guidance and timeline for reporting requirements. We'll also discuss additional progress on the consideration of SB 253, specifically Scope 3 emissions, which are due to be reported in 2027, as well as criteria on assurance accreditation for emission reports. And then, of course, finally, we'll end with a discussion on next steps in our rulemaking progress, and then welcome feedback from the public. So to get us started, I'll now hand things over to Dr. Haynes Stevens.
Thank you, Dr. Burgess. For more than 50 years, CARB has led the nation in protecting public health and reducing air pollution. CARB's work is grounded in science, supported by different governors and legislative bodies, and strengthened by partnerships with communities, industries, and public health advocates. Through regulatory innovation and collaboration, CARB has helped catalyze progress on smog, greenhouse gases, and clean transportation. As the CARB chair, Leanne Randolph, stated earlier this year, we have a legal and moral obligation to continue to pursue clean air. Next slide, please. California has long been a leader in climate policy, beginning with AB 32 in 2006, which set the state's first economy-wide emissions reduction target. We not only met that goal, reducing emissions to 1990 levels by 2020, we exceeded it, but our work continues. Continuing California's climate leadership, the legislature has enacted a landmark package of corporate climate disclosure laws to help advance transparency around corporate greenhouse gas emissions. Disclosures to be used to help inform decision-making by investors and consumers. Next slide, please. Recent legislation authored by Senators Scott Wiener and Henry Stern established California's climate disclosure laws. SB 253, 261, and 219, codified in Health and Safety Codes 38532 to 38533. For brevity, and because we see the implementation of these disclosure bills as complementary efforts, we collectively refer to them as the 200s. Next slide, please. This bill applies to large public and private companies doing business in California with annual revenues over $1 billion. Talking about, SB 253. These are the entities that will be required to disclose their emissions across all three scopes. That means not just scope 1 and 2 emissions, which cover direct emissions and purchased energy, but also scope 3 emissions, which include all indirect emissions in a company's supply chain. Legislative requirements also outline timing requirements. The first reporting year for scope 1 and 2 disclosures will be 2026 for 2025 emissions using the best available methods, and scope 3 reporting begins in 2027 for 2026 emissions. The law also includes third-party assurance requirements, starting with limited assurance for scope 1 and 2 in 2026, and moving towards reasonable assurance in 2030. Next slide, please. For SB 261, California's climate-related financial risk disclosure legislation, the law applies to U.S. companies doing business in California with annual revenues over $500 million, and it introduces a biennial reporting requirement. Starting January 1st, 2026, these companies will be required to publicly disclose their climate-related financial risks, as well as the measures they're taking to reduce and adopt those risks. These reports must be posted in a way that is accessible to the public on the company's website. As outlined in CARB's FAQ document, on December 1st, 2025, CARB will post a public docket for covered entities to post the location of their public link to their first climate-related financial risk report. CARB will keep this public docket open until July 1st, 2026. And this docket will help support transparency by providing one location for the public to be able to review all climate risk reports. Now, a key feature of SB 261 is its emphasis on leveraging existing voluntary reporting frameworks. We have received stakeholder input asking for additional guidance related to applying these voluntary reporting frameworks, and we will be talking more about CARB's draft guidance around SB 261 implementation later in this presentation. Next slide, please. Now for SB 219, it is a companion bill that introduced key modifications to SB 253 and 261. These adjustments aim to provide companies with additional flexibility and clarity as they prepare to meet this new set of climate disclosure requirements. Next slide, please. The regulatory process to implement the 200s is well underway. At the end of last year, we released an enforcement notice as well as information solicitation to garner stakeholder input. In May of this year, we held the first public workshop on the 200s, followed up with an FAQ that we released last month. In terms of next steps, by the end of 2025, CARB expects to take a regulation to the board that includes fee requirements, definitions that determine which entities are subject to the requirements of the California Corporate Greenhouse Gas Reporting and Climate-Related financial risk disclosure programs, and establish the first reporting date for Scope 1 and 2 emissions reporting. We want to highlight that all regulations developed and implemented by CARB must meet the Administrative Procedures Act, legally requiring rulemaking standards, including the clarity standard. I'll now hand the presentation off to Dr. Paul Farumo.
Morning, everybody. So at the last workshop, we started discussing foundational definitions, which will help clarify entities that are in or out of the regulation. And we received feedback in response to materials shared at that workshop. So this section is going to walk through important updates on CARB staff's work since the May 29 workshop. Next slide, please. As a refresher, the statutes include the following provisions addressing who is covered under the corporate greenhouse gas reporting and climate-related financial risk disclosure programs. The reporting entity and covered entities are defined in statute with the text shown on this slide. For SB 253, reporting entities include US-based companies with total annual revenue in excess of $1 billion that do business in California. SB 261 has the same requirements, but with a lower annual revenue threshold of $500 million. Therefore, regulatory definitions are needed to clarify the terms revenue and doing business in California. Next slide, please. At the May workshop, staff also considered defining total annual revenue as gross receipts, as set forth in the California Revenue and Taxation Code, which we refer to here as tax code. However, based on the feedback received since the workshop, there does not appear to be consensus regarding whether gross receipts are a suitable metric for gauging revenue. Based on the lack of consensus so far, we are looking for feedback on which is preferable, relying on the tax code definition or CARB developing an alternative definition of revenue. The draft alternative is shown on the next slide. Next slide, please. So based on feedback and data availability, staff's draft alternative definition is the following. Revenue is the total global amount of money or sales a company receives from its primary business activities, such as selling products or providing services. This draft definition of revenue does not deduct operating costs or other business expenses. We welcome public input on this definition and on the previously discussed alternative approach of using the gross receipts definition from the tax code. Next slide, please. So next, we will discuss the definition of doing business in California. At the May workshop, staff considered pointing to the tax code definition provided in section 23101 and shown on this slide. Next slide, please. Recognizing that we need to have a regulatory definition that is actionable, as part of our process, we have also been looking into what resources exist within the state that can be used to identify which companies are doing business in California. Based on our discussions with the Franchise Tax Board, we understand that there are statutory limitations that exist for data sharing between FTB and CARB. However, the California Secretary of State posts a public database of business entities and lists any entity with a designated agent for service of process in the state of California. Staff are working with this database to determine companies that are domiciled or have an agent of service within the state. Based on this effort, we are interested in exploring the concept of using presence on the Secretary of State database as the basis for a regulatory definition for what it means for a company to be doing business in California. Next slide, please. After identifying US-based companies, we move on to the identification and treatment of subsidiaries in their parent companies as covered entities under the 200s. Based on existing practice in the cap and trade regulation, a subsidiary is defined as a business in which another company, the parent or holding company, owns more than 50% of its voting stock. A subsidiary has a different legal business name than its parent company. And this corporate relationship implies that the parent company has a controlling interest and can influence the subsidiary's operations, management, and financial decision-making, even though the subsidiary operates as a separate legal entity. CARB will identify subsidiaries through evaluation of commercial databases, cross-reference with the California Secretary of State. Staff is exploring a process where companies may choose to self-report on parent-subsidiary relationships to avoid reporting for multiple entities under the same parent company. Next slide, please. Based on the statutory objectives and stakeholder comments received, staff propose exempting the following types of entities from the regulation requirements: nonprofit organizations, companies whose only business in California is the presence of teleworking employees, government entities not formed under business entity laws. We will be exempting the California Independent System Operator, CAISO, and generally any business entity whose only activity within California consists of wholesale electricity transactions that occur in interstate commerce. This is also consistent with an intent letter drafted by the authors of the bills. We are also currently evaluating how utilities should be treated in this program. We are interested in additional feedback on the topic of exemptions. Next slide, please. So based on the updated thinking to threshold definitions just reviewed, staff estimated the number of covered entities using currently available data sources. Using a proprietary database, staff pulled a list of US-based companies meeting the minimum revenue threshold for corporate disclosure laws, or $500 million of global annual sales volume. This amounted to nearly 9,000 companies. You can see here on the left. For a list of companies doing business in California, staff compiled a list of active businesses registered with the California Secretary of State, resulting in nearly 817,000 companies. So the goal was to match the entries in common between these data sets and generate a list of entities that both meet the revenue thresholds under 261 and 253 and are doing business in the state of California. Based on this process, staff estimate that approximately 4,200 entities would be subject to SB 261 and about 2,600 entities would be subject to SB 253. As part of our process, we intend to post the lists of the entity names that we believe are subject to these regulations in the coming weeks. Next slide, please. All right, in this next set of slides, staff will offer a fee concept for implementing these bills. Next slide, please. The 200s authorize CARB to assess an annual fee for the implementation and administration of the new reporting programs. Companies subject to SB 253 or SB 261 will be assessed the respective fee. CARB has experience with implementation fees, including through our AB 32 cost of implementation or COI fee reg. The COI fee regulation was adopted to support implementation of AB 32 and subsequently it was amended to support MRR, cap and trade, and the LCFS program. The COI fee has been assessed per metric tons of carbon dioxide emitted. While we draw on our experience with establishing similar fees to develop this proposal, there are necessary differences between the COI fee and the staff proposal for the fees being discussed here. Next slide, please. For SB 253 and 261 implementation fees, staff recommend a different approach that sets a simpler flat fee per regulated entity. A flat fee structure means that it will be the same amount for all covered entities under each reporting program. So SB 253 entities will pay the same fee and all SB 261 entities will also pay the same fee. Entities covered under both regulations will pay two fees total, one for each regulation, as each of the two fees recovers CARB's costs for a different reporting program. A flat fee structure is simple to implement and provides certainty as to what covered entities will have to pay. A flat fee for each program is calculated as the total annual program cost divided by the number of covered entities. Companies subject to SB 261 reporting would annually pay the climate-related financial risk disclosure fund fee, and companies subject to SB 253 reporting would also annually pay the climate accountability and emissions disclosure fund fee. Subsidiaries filing under parent company reports still represent separate entities subject to the fee. In summary, fee amounts will be determined based on how many entities are covered per program and the annual cost of the program. Next slide, please. This fee regulation will include a one-time charge to set up the program covering the initial $20.7 million that was temporarily funded through the Greenhouse Gas Reduction Fund in recent fiscal years. Aside from the loan payment, recurring annual fees will cover the cost of implementing the SB 253 and 261 programs, which amounts to about $13.9 million annually. These will be subject to annual adjustments for inflation and deficits or surplus in future years. Next slide. In order to provide a general ballpark for the fee amounts, staff has provided an estimate based on our best assumptions at the moment. So to estimate the fee per covered entity under the 200s, staff work with the following approach. The annual cost of implementation for both programs will be roughly $14 million plus inflation. Based on preliminary staff estimates, the number of covered entities under SB 253 is currently estimated at 2,596, and the number of covered entities under SB 261 is currently estimated at 4,160. The majority of costs and staff resources, or about 58%, will be related to the implementation of SB 253. Therefore, with these assumptions and methodology, the estimated fee for each entity covered under SB 253 will be approximately $3,106 annually, and the estimated fee for each entity covered under SB 261 will be approximately $1,403 annually. Again, these fee amounts are estimates based on current assumptions regarding the number of covered entities, but are shown here for illustrative purposes to help underline staff's proposed methodology for the annual fee calculation. Reporting entities with more than $1 billion in revenue are subject to both fees. And again, annual fees will be subject to adjustment for inflation and fund deficit surplus in future years. Next slide. On this slide, we outline the draft timeline for consideration of fee regulation during this calendar year. Following today's public workshop, there will be a three-week public comment period closing on September 11th. Staff plan to issue a notice of proposed rulemaking on October 14th, beginning a 45-day public comment period that will carry us through November. A board hearing for the fee regulation will be scheduled for mid-December. So I will now hand off the presentation to Dr. Pedro Peterson. Thank you.
Thank you, Dr. Farumo. As part of our outreach process, we understand that many companies are new to the field of climate-related financial risk reporting and have been asking us for clarity as to what minimum requirements and guidance on best available information that CARB would be looking for in the initial reporting cycle for SB 261. For the direction from the statute, SB 261 reports must be posted to the entity's website by January 1st, 2026, and every 2 years thereafter. In December 2025, 1 month before the first reporting deadline, CARB will post a public docket for covered entities to post the location of the public link to their report. The docket will remain open until July 1st, 2026. In addition to the CARB draft guidance that we'll be discussing today, a number of resources also currently exist, including the resources shown in SB 261 identifies 3 options for entities to use in developing their climate-related financial risk report. The final report of recommendations of the Task Force on Climate-Related Financial Disclosures, or TCFD, from 2017 or subsequent iterations, the IFRS disclosure standards, or a report developed in accordance with any regulated exchange, national government, or other governmental entity. Therefore, as part of our draft guidance for implementation, each climate-related financial risk report submitted to CARB should contain a statement on which reporting framework is being applied, a discussion on which recommendations and disclosures have been compiled and which have not, and include a short summary of the reasons why recommendations and disclosures have not been included, as well as a discussion of any plans for future disclosures. As a reminder, for this first round of reporting, we are accepting good faith efforts. We will accept reports that companies prepare to the best of their knowledge and ability and using the best available data. Four main principles underpin the climate-related risk disclosures, informed by TCFD and the IFRS disclosure standards: governance, strategy, risk management, and metrics and targets. Robust governance is essential for effective climate-related risk management and long-term resilience. And disclosure around governance can help ensure transparency and accountability and support investors and stakeholders in evaluating whether the company's oversight structures are sufficient to address climate-related risks and opportunities. Addressing the element of governance in our draft guidance, we recommend that each entity include best available descriptions of their organization's governance structure, if any, for identifying, assessing, and managing climate-related financial risks. Details should include information on any management oversight of climate-related risks and opportunities, and should provide a description pertaining to any board oversight of those climate-related risks and opportunities if the reporting entity has a board. As climate-related risks and opportunities increasingly shape economic realities, disclosing the actual and potential impacts of these risks on a company's strategy has become essential for investors and stakeholders. Addressing the element of strategy in our draft guidance, we recommend each entity describe the actual and potential impacts of climate-related risks and opportunities on the company's operations, strategy, and financial planning where material. Both the TCFD and IFRS frameworks recommend the use of climate scenarios to support disclosure of an entity's climate-related financial risk strategy. CARB has received stakeholder feedback that conducting scenario analysis as a detailed quantitative exercise may unduly burdensome for some reporting entities, particularly those companies that are preparing a climate-related financial risk report for the first time. CARB acknowledges these concerns and recognizes that many companies may need time to build internal expertise and capacity in the area of developing climate scenarios. Therefore, we recognize that any discussion of climate scenarios may end up being a qualitative discussion. Where a qualitative scenario-based assessment is feasible and relevant for a particular company, of course, CARB encourages its inclusion. Transparent risk management disclosures can help support investor and stakeholder confidence by helping users understand whether climate risks are being managed proactively and consistently across the organization. Addressing the element of risk management in our draft guidance, we recommend describing how the reporting entity identifies, assesses, and manages climate-related risks, including a qualitative description of the process the reporting entity uses for identifying, managing, and assessing climate-related risks, and how those considerations and processes are integrated into the organization's overall risk management. Metrics and targets are essential tools for turning climate ambition into accountable action. While narrative disclosures help identify risks and strategies, it is metrics and targets that demonstrate whether a company is making progress. These disclosures provide stakeholders with decision-useful, comparable, and forward-looking information about the organization's exposure to climate risks and opportunities and how it is responding. Therefore, in our draft guidance, we recommend that each entity disclose the metrics and targets used to assess and manage relevant climate-related risks and opportunities, where such information is material. In the discussion of metrics and targets, various voluntary reporting frameworks note that the inclusion of Scope 1, 2, and 3 emissions reporting may be disclosed if appropriate. CARB has received stakeholder input that gathering Scope 1, 2, and 3 may be duplicative with the requirements of SB 253, and that some reporting entities may need time to build up expertise in this area. As such, this requirement is not currently included as a minimum CARB requirement for this initial reporting period. Now we'll shift to discussing SB 253 and the proposed timing for the first round of Scope 1 and 2 emissions reports in 2026. Staff are considering a June 30th, 2026 implementation deadline for SB 253 Scope 1 and 2 emissions reporting. We welcome public feedback on this proposed date, particularly input related to the time costs of gathering emissions data and compiling the associated report. The implementation deadline will be incorporated into the regulation that is going to the board for consideration in December. We have received stakeholder input asking for guidance on how to report Scope 1 and 2 data to CARB. In response, staff will post draft reporting templates for Scope 1 and 2 reporting by the end of September 2025 for public feedback. We welcome input as to what data fields should be included for this initial round of Scope 1 and 2 emissions reporting.
Sorry, folks. Looks like we're having some technical difficulties. Give us 1 sec to sort this out. Thanks. Sorry, folks. Give us 1 more second.
Bearing with us, folks. All right, shifting gears. Moving beyond Scope 1 and 2 reports, CARB staff are already looking ahead to Scope 3 emissions. From CARB's greenhouse gas inventory established under AB 32, we identify transportation as the single largest emitting sector in California, responsible for nearly 40% of total emissions, 50% with upstream fuels included. These transport-related emissions are likely to be a substantial portion of Scope 3 emissions for many reporting entities across various sectors. Fortunately, many transportation-related companies are already reporting Scope 3 emissions, which may guide covered entities in developing their own reports. As part of CARB's public session on the governor's ZEV EO and 2725, some stakeholders requested that these types of disclosures of greenhouse gas emissions from transportation companies be reported. I'll now pass the presentation to Jordan to present staff's latest thinking on the assurance criteria for Senate Bill 253.
Thank you, Sid. All right. Well, this next section is meant to be an introduction to the concept of assurance. So while CARB has decades of history having data reported to us, it has only been since the mandatory greenhouse gas reporting regulation in 2007 that we started requiring third parties to review the data included in reports submitted to CARB. So while not exactly the same, CARB has an existing definition and process framework for verification through the Mandatory Greenhouse Gas Reporting Regulation, or MRR. Both concepts of assurance and verification build on financial auditing principles. So verification is a systematic, independent, and documented process for evaluation of a reporting entity's emissions data report against CARB's reporting procedures and methods for calculation and reporting of greenhouse gas emissions and product data. Systematic is defined as organized, rigorous, and thorough. Independent is defined as based on fact, unbiased, and objective. Documented corresponds to a documented process, records, and findings. And emissions data reports are judged against a set standard and to a given level of assurance. Findings are based on examination of objective evidence. And this is just an example of how we have leveraged third-party reviewers in the past on reporting programs. In the context of this new program, assurance will provide some confidence in quality of data reported to CARB. In our existing verification program, there are some key principles that overlap with assurance providers. CARB accredited verifiers must hold the following skills and responsibilities. First is do not advise and then review your own work. Next, maintain independence and objectivity. Then act with integrity and honesty. Review emissions data reports on behalf of CARB. Focus on rigor and efficiency as required for the level of assurance. And many of these criteria should apply to assurance providers. It's critical that CARB accredited verifiers maintain impartiality and avoid conflicts of interest. Conflict between self-interest and ability to maintain independence and objectivity. Conflict of interest can be real or perceived. Perceived COI can undermine public support and confidence in the quality of the reported data. Conflict of interest can damage the reputation for impartiality of a verification body or a verifier and lead to loss of accreditation. CARB already includes conflict of interest disclosures and rotation of verification bodies in other regulatory programs. And we believe these same principles on impartiality should apply to assurance providers. So what you see on this slide are specific regulatory requirements for verifiers. And we're considering similar requirements for assurance providers, and we welcome any feedback on how we may leverage parts of our existing verification program in the assurance program. Whereas verification is retrospective review of reported data, assurance processes aim to improve the quality of reported data. SB 253 calls for assurance reviews of the submitted data reports. There are three types of assurance: absolute, reasonable, and limited. CARB's existing regulatory programs rely on the level of reasonable assurance. Financial audits have a high level of rigor, and SB 253 calls for limited assurance reviews. So limited assurance involves a limited review of data and controls. Assurance is given in the negative, i.e., nothing has come to our attention that causes us to believe that the emissions data report is not materially correct. Limited assurance requires a lower level of confidence and quality than reasonable or absolute assurance. And the assurance finding could also include qualifiers if assurance providers feel the need to contextualize their findings. The implementation of reasonable assurance standards typically includes a series of general steps of which some are also common in verification efforts. Things like sampling plans, reviews of data management systems, limited data checks, completeness and calculations, limited conformance checks, process documentation, a log of any found and corrected errors by the reporting company, and a report and statement at the conclusion of the process. So we would welcome feedback on how to best leverage some of these steps in the existing verification framework for a regulatory assurance program. And with regard to the assurance standards, based on stakeholder input, staff are considering the following. First, ISSA 5000 or IAASB. Next, AA 1000. Next, ISO 14060, family. And next, AICPA. We welcome public input as to any additional standards that should be considered or any standards that should be excluded from consideration. And we will be incorporating standards into the regulation and want to ensure we include the most relevant and comprehensive standards that are currently being used. Now, as a regulatory agency, CARB is active in auditing and enforcing its rules. CARB will provide oversight through the reporting and assurance processes, and that could include auditing, reporting, and assurance activities. As a regulatory agency, CARB must ensure enforceability of all aspects of its regulations or programs, and that ties back to the clarity on roles and responsibilities for the program. And CARB can enforce on reporting regulations if there are violations. So with that, we've reached the end of the presentation portion of our workshops. I'll turn it back over to Dr. Paul Fermo as we start transitioning into the Q&A portion. Paul.
Great. Thank you, Jordan. So yeah, we thank all of you for your attendance today, and we'll move into the phase where we'll be taking public comment virtually. If you would like to ask a question or provide a brief comment, please use the raise hand function on your Zoom screen, and we'll start seeing all those line up here. Staff will aim to call in attendees in the order that they raise the hand in Zoom. Zoom phone participants may dial number 2 to raise your hand. The facilitator will inform Zoom, so myself, I will inform the Zoom phone participants when you are unmuted during the public comment and you can begin your comment or question. And dial *6 to mute or unmute. All right, so I'm seeing at the top of our list, Becky Tuhey. So Becky, you've been unmuted, and please begin your public comment. Oh, I'm sorry. Brady, Becky has dropped out of the queue. So next will be Brady Coaching. Brady Coaching, please unmute and begin your public comment when you're ready. Brady, if you're hearing this, it's your turn to speak. Okay, 0 for 2 to start this out. Let's try moving on to Pat Joyce. You're next in the queue, and Brady and Becky, if you want to jump back in the queue, we'll get to your comments. So, Pat Joyce, please unmute your microphone and begin your comment.
Hey, Paul, appreciate it. Pat Joyce here with KP Public Affairs. Making comments today on behalf of the Investment Company Institute. It's a global trade association representing the asset management industry. Appreciate the presentation. Just comments related to the slide, related to potential exemptions. I guess my question is CARB exploring other potential exemptions, or is that a finite list? I'll note that you're proposing to exempt companies that just have teleworkers. Investment funds have no employees in California. So if CARB's thinking about exempting companies that don't have, or just teleworkers, we think it's appropriate to also exempt companies that have no employees in the state. Thank you.
Thank you, Pat.
Thank you, Pat. So our next commenter will be Caitlin Kraft. Caitlin, I've unmuted your mic. Please give your comment.
Awesome. Hi there. Thank you for the presentation. I just had two clarifying questions. So the first is regarding the June 30, 2026 implementation proposed deadline for SB 253. Does this mean that the reporting year must be 2025 calendar year or fiscal year 2025? If that's the case, or would fiscal year 2024 or calendar year 2024 be accepted for that deadline? And then second question is regarding the assurance criteria. I'm just curious, if a firm has their own assurance process that is independent and that it's in a different region in the globe, would that company be able to provide assurance for if they're also completing the calculations? Let me know if that makes sense.
Caitlin, what entity do you represent? Sorry, we should have noted that if folks can state their name and who they represent, that helps us track the comments coming in.
Sure, no worries. I'm from JLL.
So much, I appreciate it. So you had a question on calendar year versus fiscal year. For that, I'll turn it over to Haynes.
Hi, Caitlin. Yeah, I just want to note that that's an ongoing consideration we're dealing with. We've gotten a lot of public input that has advocated for the same of allowing entities to compile their data or do their reports based on their fiscal years. We also have to double check that against our standards with the Administrative Procedures Act. So that is something where we are confirming and we'll certainly get out to you in the public.
And Caitlin, you also had a question about assurance. The way I interpret it is you have your own internal process for third-party assurance, and I think the question is, could you use that? Our direction is legislative direction is to develop a regulatory backdrop to implement these regulations, and so the conversation today is really around, as we develop our regulation for assurance, we need to make sure that our regulation meets all of our requirements, which of course has to be enforceable on our end and have standards that apply to everyone on our end. So I think it would be helpful to better understand, probably in a future conversation, your process for third-party assurance, so that we can see if that's something we can incorporate into a regulation. But a wholesale adoption of like someone else's process by reference would be tough from us from a regulatory perspective.
Thank you, Caitlin. Our next commenter will be Jessica Melms. Jessica, I've unmuted your microphone.
Hello, everyone. Jessica Melms on behalf of the California Municipal Utilities Association. We just wanted to say thank you to the staff for your engagement with stakeholders in this process and for considering stakeholder feedback on the definition of business entity. We support staff's proposal to clarify that government entities are not covered and therefore not subject to the reporting requirements of SB 253 and SB 261. CMUA and its members are still evaluating the proposed rationale described by staff, but we do believe that this interpretation is consistent with the plain language of the statutes and the clear legislative intent. We look forward to reviewing the proposed regulatory language and will provide further feedback if necessary. Thank you so much.
Thank you, Jessica. Our next commenter is Fernando Arias. Fernando, I've unmuted your microphone. Please go ahead.
Hi, everybody. My name is Fernando Arias, and I serve as Director of Sustainable Construction at HIT Contracting. I lead our company's carbon neutrality goals and oversee our internal team responsible for annual emissions reporting, in addition to supporting strategies to reduce carbon impacts across projects and operations. Regarding Senate Bill 253 and 261, the current language sets an absolute reporting deadline of January 1st, 2026. And given the need for reporting companies to gather prior year data and have it assured before submission, will CARB consider establishing a reporting window, for example, during Q1 of the reporting year, rather than a fixed January 1st deadline? This adjustment would provide companies the necessary time to prepare accurate, assured data while still meeting the intent of the legislation. Thank you.
And I want to make sure that I understood your comment, but also clarify January 1st is the date by which in statute, so legal requirements set in law already for the climate related financial risk reports that are due per SB 261 for scope 1 and 2 reporting. CARB is required to implement collection of scope 1 and 2 data at a date to be determined in 2026, and we're proposing June 30th as to be included as part of our regulation. So I just want to make sure we're not talking past each other.
Got it. If I'm still on the mic, I'd say thank you for the clarification. So just to reaffirm that I understood, the reporting will be required by June 30th of 2026.
For scope 1 and 2 reports. That's our current, that's staff's current proposal to have that date baked into an upcoming regulation.
Okay, cool. Thanks, Sydney, for the clarification. I think a little bit of an extra emphasis on that clarity in the comms will help us all. I think it was a little bit hidden inside of the things that I've been able to read. Appreciate all the comments. Thank you.
Thanks so much.
Thank you, Fernando. Our next commenter will be Muriel Strand. Muriel, I've unmuted your microphone. Please go ahead.
Yes, I'm Muriel Strand. I'm a retired air resources engineer. And I just wanted to kind of speak to the larger frame of our situation. As you know, we all live on the same planet. So really, we all have the same goals. Regulations are a trial sometimes. So I just want to mention that the reason for regulations is market failures. So let me just name some sources of market failure. The adversarial relationship between business and government, the profit first orientation, our fossil fuel addiction, and the externalities, mostly environmental, that are not captured in the standard financial model. All these are sources of market failures. So we need to work together. And I'm hearing like a great attitude, excuse me, from a lot of people. So it makes me feel hopeful. So yeah, we're all on the same team. So in our current regime of fossil fuel addiction, we are living with an energy power that is radically different than what we evolved with for millions of years. And so in human evolution and survival, the individual maximizes their survival by being selfish, but the group maximizes its survival by cooperation. So I'll be sharing more comments later. Thanks again to everybody.
Thanks, Muriel. Great to hear from you. A lot of appreciate your comments. A lot of them are out of scope for the regulations that we're talking about today. Appreciate you being here. Thanks.
Our next commenter will be Dana Weiss. Dana, I've unmuted your microphone. Please go ahead.
Thank you. My name is Dana Weiss. I represent Verdani Partners. We are a ESG consulting firm, a sustainability consulting firm for commercial real estate owners and managers. I have 4 questions, so please bear with me. For investment managers and registered investment advisors that operate and manage funds, are the funds the obligated reporting entities, or would the investment managers or advisors be the obligated reporting entities? My second question is for joint partnerships. This is for the revenue definition. If an asset is sold for which the reporting entity has an equity ownership that is less than 100%, would the percentage of equity be considered as part of the gross receipts? So for instance, if it was only a 5% ownership, would only 5% of gross receipts be considered for the revenue definition? My third question is, if all subsidiaries of a parent company report individually? Is the parent company's obligation to report fulfilled, or does the parent company need to report as well? And then lastly, regarding SB 261, I see that the docket is intended to remain open until July 1st, 2026. But the deadline is still July 1st or January 1st, 2026. Does the docket remaining open allow for late submissions or updates to the submitted links, or is there a different intention entirely? Thank you.
Thanks, Dana. I'll just put a couple of those themes together, just starting backwards. So for SB 261, let me be clear that the legislation, so existing law, requires companies to post their climate-related financial risk reports to their own website by January 1, 2026. Nothing CARB can say or do would override that. We are trying to allow for a gracious entry into the program by allowing extra time for folks to get back to us to let us know where that link is on their websites themselves. I will just also note, I think the other questions that you had are related to the definitions that we've been putting out. As we mentioned in our presentation today, we are looking for feedback as to whether or not these definitions help provide clarity as to whether or not companies are in scope or out of scope for the regulation. So part of the process today is trying to seek feedback on whether or not we got these definitions right. And if we did not, what specific changes would be needed to make our definitions more clear.
All right, our next commenter will be John Scheidler. John, I've unmuted your microphone. Please go ahead.
Great, thank you. John Scheidler from Omnex Future Past. We're a greenhouse gas verification body. The U.S. District Court for the Central District of California last week said that Scope 2 and Scope 3 emission disclosures are factual in nature, in that they are both defined and have recognized methods of computation. We don't disagree with the court's statement about Scope 3 emissions being factual in the sense that they are defined and have recognized methods of computation. However, we'd like to raise a different point. Our standards for verification compel us to find that statements of emissions are true and fair, just like a financial auditor must find that financial statements are materially true and fair. The question is whether the Greenhouse Gas Protocol's second and third allowed methods for quantifying Scope 3 emissions will allow verifiers to conclude that reported Scope 3 emissions are true and fair. We have doubts about this. To review, the first option for reporting Scope 3 emissions is to obtain Scope 1 and 2 emissions from the supplier or other party whose emissions are being reported. We believe that this method will enable verifiers to conclude that the reported emissions are true and fair. We don't believe, however, that the second and third options provided by the Greenhouse Gas Protocol enable a verifier to state under penalty of perjury that it has found the reporting to be true and fair. This is because verification opinions rely on much more information than the mere confirmation that quote unquote methods of computation are accurate.
John, I appreciate the comment. Can't comment on pending litigation, but appreciate you being here.
Well, excuse me, it's not really about
sorry,
the
John.
litigation.
Sorry, John. The 2 minutes are up. Next.
Thank you. Our next commenter will be Peter Kwan. Peter, I've unmuted your microphone. Please proceed.
Thank you very much. First of all, thank you for the presentation today. This is Peter Kwan, and I represent Samsung Electronics. I have two questions about the fee structure and the parent-subsidiary relationship as it is currently being planned by the staff. So, Samsung Electronics has multiple subsidiaries in the United States, including some of which are located in California. And with regards to fee payment, Would a parent subsidiary that's located in California have to pay fees for multiple companies, or would the fee payment be on a reporting basis? That is, if the parent company files a single report as a representative report for multiple subsidiaries, would the payment be only carried out once? So that's my first question. And the second question is, if a subsidiary to a parent company is located outside California, and as far as we understand, doesn't fall within the scope of either SB 253 or 261, would the parent company, if it chooses to file a consolidated report, be required to report details about that subsidiary that has no obligation to either bills? An example that I bring up is Samsung Electronics America has as a sub-subsidiary Samsung Electronics Mexico. And as far as we understand, Samsung Electronics Mexico doesn't fall within scope. And we want to find out whether it would be required of us to try to report details about Mexico as well. Thank you.
Hi, Peter. Thanks for being here, and thank you for your questions. With regard to part one there, still working out the logistics, but the intention is that each subsidiary would pay, or even if the parent company were to pay for all the subsidiaries, the total amount would reflect each subsidiary that is subject to the fees. So the total amount would be the same, whether it's collected at the top or paid at the subsidiary level. On the second question, the subsidiary is the covered entity. The SB 219 does allow for parents to report on behalf of that subsidiary. Thank you.
Thank you. Our next commenter will be Randy Morrison. Randy, I've unmuted your microphone. Please proceed. Randy, if you're speaking, your microphone is not unmuted.
Okay, I think, can you hear me now?
Yes, now we have you.
Great.
Thanks.
Okay, thank you. So good morning. I'm Randy Val Morrison, General Counsel and Chief Knowledge Officer of the Society for Corporate Governance. Founded in 1946, the Society is a professional membership association of more than 3,700 corporate and assistant secretaries, in-house counsel, outside counsel, and other governance professionals who serve approximately 1,600 entities, including 1,000 public, private, and nonprofit organizations of almost every size and industry. Our members have extensive experience with governance, risk management, and disclosure, both in general and in the context of climate-related matters. In addition, we've conducted a thorough information gathering process in connection with our March response to CARB's information solicitation. Therefore, we believe the Society is well positioned to provide constructive feedback to CARB on the disclosures required by SB 253 and 261. My remarks today draw on our members' overall experiences as well as insights gained through our comment process on SB 253 and 261. Given the time limit, I'll get back in the queue and seek your permission to address important timing-related concerns in a separate comment during this workshop. My first remark focuses on the doing business definition. We agree with the definition based on California Secretary of State registration under Section 191 of the General Corporation Law, which would enhance clarity and potentially carve out entities that don't directly operate in California. However, we believe that also requiring a California-specific business income threshold for companies incorporated outside of California is important so that CARB can ensure a strong nexus exists between the state's interests and the climate reporting requirements. There's precedent for a jurisdiction-specific revenue requirement in international sustainability reporting regimes, such as the EU CSRD, under which reporting is currently triggered at 150 million euros annual global revenues for EU entities, but at 150 million euros annual EU revenues for in-scope entities that are not EU entities. Whereas California's Secretary of State registration is required when a non-California company transacts business in California, a meaningful California-specific revenue threshold, for example, 20%
Hey,
of the
Randy.
total Yes.
Sorry to interrupt you, but your time is up here. We do have, I think there's something like 86 people that have their hands raised right now to speak and limited time left for the workshop. So I encourage you to submit written comments to follow up. Thank you.
Our next commenter will be Meg Snyder. Meg, I've unmuted your microphone. Please go ahead.
Hi, good morning. This is Meg Snyder with Axiom Advisors. Wondering if TCFD disclosures will be sufficient for SB 261, the deadline that's in January 1st, 2026, and also wondering if existing group emissions will be sufficient for SB 253 for that June deadline. Thank you so much.
Meg, so your first question was on SB 261. Yes, the legislation outlines a number of different voluntary frameworks that are acceptable for reporting by Jan 1. I believe you mentioned one of them that is on the statutorily allowed list. So specifically TCFD 2017 or subsequent iterations of that framework can be used in addition to a couple of others. So that's an easy yes. I'm not sure I was tracking with respect to group submission question. Given the time limit, please feel free to follow up with us after.
Our next commenter will be Zilin Chen. Zilin, you're unmuted. Please proceed.
Hi, this is Jillian Chen representing Dematic. I have a few questions, and number one is that, so how do you determine the company in the US? For example, we have a parent company that's way out there in Europe, yet we have this like tax ID entity in the US that has business in California. In reporting, will we only be looking at the US entity, or it will be looking at a more parent company covering everything level? And second question is that you mentioned the assurance audit. So can the audit go back to the parent company level as well, or it will be focusing more on a subsidiary that's filing taxes in the US and doing business in California? And another question is still on the fees. I've heard a question before, still need some clarifications on that. So you had a fee estimate. Will it just be like this one-time fee payment for the company that's like reporting, or it will be like, for example, you've had multiple subsidiaries under the US subsidiary? Do I need to pay, like multiply that number, or it will just be like one fee, that's all? I think that's the three of my questions. Oh, and lastly, has there been any like updates on the penalties?
Hey, good morning. Thank you for your comment. I can take the last one on the fee side. Just an easy answer is that it's an annual fee per subsidiary that would be covered. And I'm going to turn it over to one of my colleagues to address one of the earlier questions that you had there about some of the definitions.
Yeah, so we're talking about annual fees. Each subsidiary will be on the hook to pay those fees. If you're a parent company who wants to pay on behalf of them, then yes, multiply by however many subsidiaries are covered. And just to be clear, we are seeking feedback on proposed definitions to provide clarity around, which companies are in versus out of the regulations. If there's specific recommendations on how we can refine those definitions to be more clear, that would be very helpful in terms of comments. As a reminder, the legislation outlines that to be subject to this regulation, you need to be a US-based company doing business that is also doing business in California.
Thank you. Our next commenter will be Jason Fox. Jason, I've unmuted you. Please go ahead.
Hi, Jason Fox with the California Society of CPAs. Appreciate CARB's willingness to engage with stakeholders to date, and these workshops have been very helpful. Appreciate the detailed conversations and feedback. We certainly are going to provide additional written comments around the assurance piece. Is very important to the CPA profession. I just want to kind of note for the record that CPAs in the accounting profession have very well-defined and rigorous standards around addressing independence, ethics, objectivity, a licensure regulatory framework for the profession, how they operate, that fits well with some of the concepts that CARB is looking at for the assurance providers. And so we'll provide additional feedback on that and appreciate the dialogue going forward. Thank you.
Thank you, Jason. Our next commenter will be Justin Fritz. Please go ahead, Justin.
All right, thanks so much for the presentation. I'm Justin Fritz with United Wholesale Mortgage, and really just a similar question to a lot of those about the 253 and the 261. Specifically about the 261, we're going to use the TCFD in our approach, but in their metrics and targets disclosure B, it says go ahead and release scope 1 and scope 2. But my question is, if that's for prior year, that's going to be for the 2025 year, and it's going to be due on 1/1/26. So is that a best efforts to get through as much as 2025 as possible, or is that really primarily looking at the 2024 for the 261? Because in a perfect world, it'd be nice to have the 253 disclosed in the first quarter, which would give you all of scope 1 and scope 2 for 2025, and then be able to have your climate report mirror what you're saying with the 253. Thank you.
Justin, just to clarify, one document that I'd like to direct you to, and actually we'll take speaker's purview to also direct all folks who are listening and interested, back to a couple of documents we have on our website. I think one place that might be helpful, and others who have your same question, Justin, we put out recently in the last couple months an FAQ to help address some of those questions. In the FAQ specifically to 261, one of the items that we outline is that if you're going to use emissions data as part of your 261 report, that as we are bringing companies into the program in this first year, to use the most recent that's available to you. Also, thanks for giving TCFD a shout out. I'll just also take this opportunity to remind folks that the legislation outlines a number of different voluntary frameworks that can be used. So I know a couple of comments have brought up TCFD already, and I just want to put a finer point on there's a couple of voluntary frameworks that you have at your disposal. Thank you.
And Justin, I just wanted to add to your question about reporting scope 1, 2, or 3 emissions with your 261 disclosures. We did get feedback that some of that data may be duplicative with the 253 reporting, and that some entities are going to be subject to 261, but not 253. And it may take some time to build up expertise in this area. So right now, at this time, the requirement to report scope 1, 2, and 3 emissions with the 261 disclosures, we're not currently thinking of that as a minimum CARB requirement for this initial reporting period.
All right, great. Thank you. Our next commenter will be Natalia Pascual. Please go ahead with your comment, Natalia.
Hi there. Thank you all so much for hosting this workshop. My name is Natalia. I am representing Agendi, and we're a sustainability consultancy helping companies with voluntary and mandatory disclosures, including these California regulations. I have 3 questions today. The first is for the fee structure. Is the intention for companies to pay these in non-reporting years as well? So, for example, is the SB 261 fee annual, even though the reporting period is biannual? And then similarly, what about the companies that are right on the cusp and may fall out of scope in between reporting requirements? My second question is, how does the June 30th, 2026 deadline for scope 1 and 2 emissions disclosure apply to companies whose fiscal year ends after December 2025? My understanding was that the law actually specifies disclosures were tied to the company's fiscal year, which would suggest maybe an end of year deadline or a rolling deadline for companies with later fiscal years, for example, ending in March. So hoping you can clarify that a little bit. And then the last question is, I believe you mentioned that CARB was looking at the California Secretary of State database to determine companies that may be in scope. Is this intended to determine who is officially in scope through the definition of doing business in California? Or is that just one of the databases you were using to support the research? Thank you.
Great, thank you. I'm going to take these out of order, probably. So I think your first question was about the fee structure and annual payment versus biannual payment. The legislation does direct that we have an annual fee associated. I think you're asking about 261. So it does specify that the legislation always states an annual fee would be required. Let's see. might need an assist for the number 2 and number 3. I think number 3 was related to Secretary of State and how we were using that data. So for the Secretary of State data, we were looking for what data is available with respect to who is doing business in California. Our first stop was the Franchise Tax Board. A lot of the public comments and feedback we received from stakeholders like yourself had thought that Franchise Tax Board would be a good first stop. We stopped off there and learned that they may have some legislative statute issues with data sharing. And so our next stop was Secretary of State list, which has a benefit of also being a publicly available list. It does not have the volume of revenue associated with the businesses, but it does list businesses, it appears to us, that are doing business in California. So the process that we described earlier in the presentation was taking a database of company names and revenue of US-based businesses and their revenue, and then we overlaid that with the Secretary of State database to get a list of the businesses that we felt were both doing business in California and were US-based businesses that hit over the revenue thresholds that are outlined in the statutes. I hope that is helpful.
And I can just answer the fiscal year again question. For SB 253, the statute states that emissions reporting will be corresponding to the reporting entity's prior fiscal year. I hope that clarifies things.
Thanks, Haynes. And I did want to address that second question as well, just to add on to what Haynes said there. I'm hearing you say there may be a mismatch in the timing and the data availability with regard to that June 30th deadline. We would appreciate your written feedback on that proposed reporting deadline and its feasibility with regard to data availability. So please let us know your thoughts on that. Thank you.
Our next commenter will be Mei Vu. Mei, go ahead and proceed with your comment, please. I've unmuted you.
Hi, my name is Mai. I'm here on behalf of the Wonderful Company LLC. I have 3 questions today that I'm going to try to ask in a very organized manner. The first question I have is whether or not the third-party verification reports under SB 253 are also applicable under SB 261. My second question is regarding when are the regulations going to be finalized? And my third question is if there are any discussions around deadlines for Scope 3 emission reporting and if there's going to be any anticipated flexibility there. Thank you.
Thanks, I appreciate it. Okay, moving kind of in reverse order, you had asked about flexibility and deadlines for SB 253 and Scope 3. To put a finer point on that one, that is one of the reasons why we want to start shifting our focus to talking about Scope 3 between, guidance, this workshop, and our upcoming regulation that'll be going to the board in December. Our initial deadlines for SB 261 and Scope 1 and 2 for 253 should be on a good path there. So we do need to start shifting to talking about Scope 3. At our last workshop, both Senator Wiener and Stern, who are the authors of the 200s, came to speak, and one of the things they put a really fine point on was that the deadlines that are set in legislation are set, and they do not have any intention of moving those. So that's one of the reasons why we wanted to pivot today to start thinking about Scope 3 and start getting feedback on those. Jordan or Haynes, would you like to take any other pieces of that?
I was a little unclear on what the first part of the question was asking with regard to assurance and 261. Maybe if you could follow up in your written comments there or send us an email to the climate disclosure box, we'd be happy to follow up with you.
Great. Our next commenter is Matthew Rusk. Matthew, you've been unmuted. Please proceed.
Oh, thank you for the session today and all the great efforts by you all and the agency. I'm representing DigiNext. We help organizations perform sustainability and human rights due diligence and produce disclosures and navigate the evolving regulatory environment. And I really appreciate the FAQ document and some of the clarity that you've provided. So sorry if the question remains a little feeling a little redundant, but there still remains some debate as if for satisfying 261, if data from fiscal year 2024 will be acceptable if it's to TCFD or IFRS S2. And once again, I appreciate the acceptance of a number of different frameworks or standards. Could you clarify if it's the entirety of that data can be from fiscal year 2024, or if there's only a subset of data that's acceptable to meet that requirement by January 1st, 2026? Thank you.
Thanks, Matthew. Appreciate the shout out to the FAQ. That always warms our heart. What we were trying to convey in the FAQ is, we recognize that this deadline is coming fast and furious. And so the intention here is to provide an on-ramp for companies to, comply with 261. And so I believe that the FAQ was trying to convey is to please use your most recent data that's available. So if for a company you're advising, if what they have is for 2024, and that's the most recent that they have, obviously, please, please feel free to advise them that that would be very useful. What we don't want to do is provide advice that if you have both 2024 and 2025, and it is possible to compile 2025 for a January 1, 2026 report. Obviously, we're interested in the most recent and best data that's available. But if 2024 is what they have, and that is all they have, please, yes, we're very interested in that. I would say too, you're not alone in those comments. We've definitely heard from a couple of companies that the process of compiling, say 2024 data, it takes them through much of 2025 to then report by Jan 1, 2026. So we've definitely heard that comment before. I hope that helps. I hope that's what the FAQ conveys. Thanks.
Right, our next commenter will be Allison Dowd. Just like to remind all the attendees that we have more than 90 hands raised, 90 comments to get through. So please be as succinct as possible in your verbal comments. And again, we have a public docket open for 3 weeks, so you'll have plenty of opportunity to submit written comment. Allison, go ahead. You've been unmuted.
Hi, yeah, thank you so much for all of this. I'm representing Aviva. We're an industrial software company doing business in the state of California. 2 questions for you. I know that you're still thinking a little bit about scope 3, but curious as to if you've had any thought about what would need to actually be assured or verified. Would you be looking for all relevant scope 3 categories for a company or those that are most material? And if so, what would that materiality threshold be? And then my second question is a little bit more clarity on the parent and subsidiary clarification. So Aviva is wholly owned by Schneider Electric, but we operate completely independently, and just curious as to how that type of relationship would work. If we are not included in Schneider Electric's reporting, that I would assume means that Aviva needs to report on their own, whereas if we are included in their reporting, then Aviva would not need to potentially report on their own. Any clarification you could offer would be super helpful. Thank you.
Sure, happy to take a first stab at that, and others can feel free to jump in from the team. We are, on your first comment, we are looking for comment and input on how to define material categories or thresholds. So any substantive thoughts you have there would be useful. I hear in your comment, and then some of the other comments we've been hearing today, and then at the past workshop, there's a little bit of confusion over the parent-subsidiary relationship and reporting. Just to put a finer point on it, Senate Bill 219 provides the option to report at a parent level, but that's not a requirement. So if you're a subsidiary and you're doing your own reporting and your parent's not reporting on your behalf, that is perfectly okay too. The SB 219 just provides the option for parents that are already reporting at that higher level to provide that report to us. So I hope that's helpful. It is meant to be a helpful option, but it appears to become a point of confusion. So I hope that helps a little bit.
Okay, our next commenter will be Omer Amar. you've been unmuted. Omer, please proceed.
Hello, can you hear me?
Yes.
Yeah, thanks so much for hosting the webinar. This has been really helpful. I'm Omer from Arbor. We help companies measure and report on their scope 1, 2, 3 emissions. We have a few clients for SB 253. My question is around the revenue threshold. So if a company made more than $1 billion in 2025, but is expecting to make less than that in 2026, should they prepare the scope 1 and 2 disclosure and then not prepare the scope 3 disclosure with the 2026 data for 2027? Let me know if that makes sense.
I think the goal of just to put a finer point on goals of the workshop, we are trying to get into place a regulation that would go to our board the end of the year, so December, that very clearly outlines who is in and out of the regulation. And that includes a number of different threshold questions around revenue and doing business in California and other very foundational concepts. I think what would be helpful for us is understanding whether or not our definitions are helping clarify whether or not a company is in or out. And if it's unclear, then specifics around how we might modify those definitions to help answer questions like these. That would be very, very useful because December is right around the corner in terms of regulatory thinking.
All right, our next commenter will be Megan Bloomer. Megan, you've been unmuted. Please proceed.
Hi, thank you all so much for the webinar. My name is Megan Bloomer. I am the Vice President of Sustainability with the Cheesecake Factory. My question is specific to third-party assurance providers. You mentioned that there are some that are CARB approved under some other programs in CARB. Is it expected that limited assurance for 253 would only be provided by entities that are CARB approved? Thank you.
No, that is not the intention. Thank you, Megan.
Our next commenter will be Cassandra Martineau. Cassandra, you've been unmuted. Please proceed.
Thank you. My name is Cassandra Martineau, representing Sun Life US. As you develop the regulations, I'd like to request clarity on 3 points. One is when these entity names will be published that you've identified as covered entities, and whether that will be a list that is refreshed annually, and if so, on what time frame. And then if we believe there are inconsistencies with our own legal review of applicability, what the forum for that discussion will be. For example, will reporting allow for justification of exclusions of entities identified, or does exclusion automatically proceed to enforcement actions after the grace period? The second point is providing some clarity on whether companies whose parent entities are located outside of the US and are subject to other global regulations with similar requirements, including assurance, whether there will be an opportunity to submit some kind of attestation to that effect to alleviate the burden of repeated reporting when there are substantially similar requirements. And then if we have an entity in the US that does business in California that reports consolidated financials for a series of smaller entities, whether that revenue threshold applies to the consolidated and audited financials or to an entity's standalone financials. Thank you.
Great, thank you. In short, we are working on putting out an initial list of businesses we think are subject to the regulation for public feedback. Our goal is to try to get a handle on who is subject, but whether or not you're on the list does not necessarily alleviate you from your own assessment of whether or not you're in or out. So if our list does not include you, but you're in, then that burden would obviously fall to the regulated entities. In terms of specifics around who is subject, providing justification as to whether or not you're in and out, in your parent subsidiary company questions, these are all great questions and things we're looking for input on. Our regulation needs to be very specific on these points in order to meet our clarity standard that we have to develop when we write these regulations. So again, seeking public input on how best to navigate some of these questions so that we can be sure that our regulation meets our clarity standard.
And just to add as well, just to streamline the communication with our stakeholders with regard to whether you see inconsistencies with that list that we're going to publish of who we think initially might be covered. We're looking to put out a form of some kind, an online form that people can fill out and send to a central database on our site. So more to come on that.
Our next commenter will be Francesca Ho. Please unmute yourself and proceed.
Hi, thank you very much. I'm calling from Deloitte LLP. So our sustainability assurance practice in the UK. So darling, I'm from London, so good evening. Thank you so much for the session today and the open dialogue on these questions. I have two questions which you've started to touch on, but with a bit of an overseas spin. So the first, I think you've started to clarify this already, but we'd just like explicit confirmation. In the UK, we have several companies and partnerships who do business in California on the basis of sales and payroll, and have global revenue of over the 500 mil and $1 billion thresholds, but they're registered in the UK rather than the US. Could you explicitly confirm if these entities are expected to comply with the 200s? And the second question is that if, say, there is a US subsidiary which meets these thresholds, which is a subsidiary of a UK registered parent, could it rely on the disclosures of that non-US parent, assuming that there is equivalence in the reporting frameworks? Thank you very much.
Great, thanks so much. Hard to comment, on specific companies and their situation. I'll just say that the legislation is specific that this law applies to US-based companies that are doing business in California.
Okay, our next commenter will be Michael Cheatham. Michael just dropped out of the queue. Our next commenter will be Daniela Arias. I've unmuted you. Please proceed with your comment.
Hi, thank you. Thanks for time today. I'm Daniela Arias. I'm with Crow LLP. We're a CPA firm working on both assurance and consulting engagements around California climate rules and other regulatory reporting. So I have two general questions here. One, you've mentioned there's a couple of different frameworks that companies can use to be able to start reporting on SB 261. CDP reporting, a voluntary reporting mechanism many companies use, is based on a framework such as TCFD. So my recommendation and ask would be that the team make maybe some clarifications around whether the structure of something like a CDP report would be acceptable for purposes of this legislation. And really, that's all the comments I have. Thank you so much.
Great, thank you. So in terms of the question around 261 in compliance, if the report is TCFD based on TCFD 2017 or subsequent iterations, in that context, it would meet the requirements of the legislation. We're also putting out draft guidance based on asks like these as to the minimum requirements that CARB will specifically be looking for in this initial year. So interested if your clients have specific feedback on that. Thank you.
All right, thank you. Moving on to our next commenter, Connor Merrigan. You've been unmuted. Please proceed.
Hi there. Thank you so much for this webinar. Connor Merrigan, I'm with Montrose Environmental Group, where I lead the sustainability and assurance work that we do. My comments are specifically about assurance today. I really appreciate the guidance on the standards. We'll be providing some comments there. But my follow-up question would be whether you have also, at this time, made any sort of designation around accreditation for assurance bodies, and whether that would be a requirement as part of the allowance for these assurance bodies to do their work. And so my second question, just to build on that first one a bit, the sort of ISO 14065 as one example, and certainly others that would require the assurance body to go through a third party, effectively assurance/accreditation themselves. And then the second question, also related to assurance, is whether there has been any consideration of looking at a staggered timeline for the assurance portion, of the SB 253 emissions, whereas they might close on June 30th, but then perhaps even have until the end of the year, which seems like a reasonable timeline to accommodate assurance processes for all the reporters to have that portion done. I think there's a number of good reasons to look at that staggered reporting, and that is what often happens in the private sector. Those are my questions. Thank you.
So hi, Connor. Thanks for that question. Rajendra Sahota here, Deputy Executive Officer at CARB. On the assurance pieces, we are interested in leveraging the existing systems out there for accreditation and for processes that are already in common practice. So we'll take all of that input and try and reference all of those to the extent that we can in our regulation. I think the key here is that we don't want to create a whole new system when there's a system that's already been in practice and already working out there. We want to focus on working with reporters so that they can submit their reports and they understand what they need to provide, and make sure that the people that are going to be providing these services for assurance are credible, that they have the expertise, that they have the right certifications or licenses to provide these services. Because at the end of the day, we want data that is meaningful for consumers and for investors. And so take your point that there are a lot of folks out there that we can leverage. We want to know who all of those accreditation bodies are and those certifications are. On the staggering, we actually did do that kind of staggering for our own mandatory reporting greenhouse gas program. So we're happy to take feedback on what kind of staggering we could consider for this program as well. And just to put it into context, our mandatory reporting program has a little over 700 reporters that have to get their data reports verified. We're talking about thousands here. So we see the workload looming out there. We see the infrastructure that has to be set up to support this. And so we welcome any information and any experiences that you all want to share so that we can launch the program in a successful way and make sure that we're not setting ourselves up for some impossible deadlines or impossible requests of the broader community. Thank you.
Our next commenter will be David Edsey. David, you've been unmuted. Please proceed.
Yeah, thank you for the opportunity. David Edsey from Zurich, North America. My question is in regard to SB 253, and specifically the reporting of scope 1 and 2 emissions. So I know there's been some parent subsidiary questions already asked, and that's the nature of my question. My company is a subsidiary of a multinational Swiss-based company, and we report on our scope 1 and 2 emissions on a group-wide basis in our annual reports. So that includes, our emissions through many regions throughout the world. So my question is, would that group-wide disclosures that we're making comply with the reporting requirements under 253, or would you require specific US-based emissions only? Thank you.
I really appreciate the comment. I think as we develop our regulation and as we're looking for input in terms of what scope 1 and 2 emission data fields should be reported and what we should include in our upcoming Excel probably based spreadsheets that we will be putting out, it would be helpful to receive comment as to what is doable or probably more useful to investors and consumers who are looking to make investment choices in various companies or making decisions that are aligned. And so receiving public comment, in kind of these like gray areas or receiving written comment will help us as we start to navigate the regulatory text. So if there's ideas that you have about how to navigate these specific kind of situations, we're very open to hearing them.
Thank you. Our next commenter will be Mike Gillette. Please go ahead, Mike. You've been unmuted.
Thank you. This is Mike Gillette from the American Bankers Association. I really appreciate you taking the time out here. Just two things. One more maybe clarification of the process. I see that you've presented kind of more of a different kind of definition for revenue that kind of, and indicating it conforms to Dun and Bradstreet, S&P kind of methodology, and that's fine. In the May 29th workshop, there was also a point where you were also considering whether income sources in the financial sector, investment income, whether they would not be considered as revenue. I just wanted to make sure, is that thing still on the table that you're considering, or is that something you've said and you've resolved and said, okay, never mind that, or how are you thinking about that, and how should we think about other points that you've kind of gotten past as we go forward here?
For the question, I appreciate that. So in the aftermath, I guess, of the initial workshop, we received a lot of public comments and had a lot of one-on-one meetings about how exactly to navigate the definition of revenue. And there does not seem to be at least consensus with those that we've talked to about whether or not relying on the tax code definitions as we originally proposed is the right way to do it. And so for the purposes of this workshop, what we wanted to put forward is, a couple of options for feedback. So the question really is, should we rely on the existing definition that's in code that we put forward, or should staff be looking at developing our own definition of revenue? And if we were to develop it, what we've put out today is how we're initially thinking about how we would define it. So I think it would be helpful for us to all hunker down on what exactly the definition of revenue is, because we've heard a lot of potential issues with the existing tax code definition. We've heard that it would be good to rely on existing tax code definition. We've heard we should or should not create our own definition of revenue, but we need to start all yelling around what exactly would work for companies that may be covered by this upcoming regulation. So we're literally looking for feedback, because now is the time when the rubber really hits the road in terms of developing regulatory text.
Our next commenter will be Stephanie Jones. Proceed with your comment.
Thank you. Hi, my name is Stephanie Jones. I'm a senior attorney at Environmental Defense Fund. We'll start by thanking CARB staff for their diligent work on developing a sound, practical framework for implementing California's vital climate risk disclosure laws. We understand the complexity of this task, and we appreciate the depth of thinking evident in today's discussion, including on how to operationalize the law's applicability thresholds for revenue and doing business in California. As CARB continues to develop the process for identifying entities that meet these thresholds, we want to note the potential merits of utilizing data from the Franchise Tax Board. We believe that FTB data could play a valuable role in ensuring that the criteria for applicability and exemptions are clear and verifiable. We understand that state agencies must be given explicit authority to access many components of this data based on a need to know or right to know basis, which may take time to establish. So in the interim, we encourage CARB to consider working with the FTB to identify key fields that could be included in an annual summary report from FTB to CARB. Additionally, CARB could work with the FTB on receiving a high-level anonymized FTB dataset that could be used to validate the feasibility of CARB's definitions and program design without implicating sensitivities around individual company data. This approach would provide some of the data needed to begin building an enforceable and durable program while the agencies continue to work through authorizations for further data sharing. Partnership with the FTB could help ensure that CARB's program is grounded in a reliable and consistent data source, strengthening the program's integrity and long-term success, and supporting California's leadership on climate-related disclosures. We appreciate the ongoing opportunities for the public to engage and provide recommendations during this process. Thank you.
Thanks, Stephanie. Appreciate it. I'll just say we have had discussions with FTB, and our understanding of their boundaries is that their data sharing is quite limited under statute, which is why in this presentation we have pivoted to proposing to use Secretary of State databases and information. Thank you.
Thank you, Stephanie. Moving on to our next commenter. Apologies if I mispronounce your name. Siddhipriya Navalpakam. Please unmute yourself and proceed with your comment.
Hey, hi. This is Sri Priya representing Clorox. Just a quick question. The earlier clarification on most recent data was super helpful, but I just wanted to double check calendar year data. Most recent would also be acceptable. That's the first question. The second one is, again, we have to post it on our own website by January 1st, but the official deadline to drop on the docket is July 1st. Thank you.
I can take that question. SB 253 outlines that emissions should be compiled for the prior fiscal year, whereas SB 261 doesn't specify that, in which case calendar year data is permissible. And then you are correct that the reports are due by January 1st, 2026. CARB will be opening the docket on December 1st of this year, and then leaving it open for until July of next year.
Thank you. Our next commenter will be Julian Harrell. Julian, please proceed with your comment.
Thank you. Can you hear me okay?
Yes, we can hear you just fine.
My name is Julian Harrell. I'm calling as a general practitioner in the space and an interested citizen. I have two questions. The first is, does CARB's enforcement discretion for this first reporting cycle under SB 253 apply to or extend to the limited assurance requirement and or scenario analysis? And my second question is, how long will any additional guidance continue to reference the TCFD standard now that IFRS and ISSB have effectively absorbed that framework? Thank you.
Hi, Julian. I believe the statute specifically calls out TCFD. I might be wrong there, but so it's part of the reason why we've been including that in our materials. With regard to enforcement discretion, yes, we have broad enforcement discretion across all aspects of the reporting regulation that will be out eventually.
Our next commenter will be Samantha Weinberg. Please proceed, Samantha.
Hi, thank you so much. I'm Samantha. I am here representing Agendi, and we're a sustainability consultancy that helps companies with voluntary and mandatory disclosures, including these California regulations. I first really want to thank the representatives here from CARB and for this time today. I really appreciate you taking the time to provide these updates and take feedback on board throughout the process that you're going through. One of the things you mentioned you're looking for feedback on is the data fields that would be submitted for SB 253. I was wondering if you could expand on the kind of data fields you're looking for, if you have ideas already, or the type of feedback you're looking for. As an organization that helps companies calculate their GHG emissions, this is something we'd love to provide feedback on and want to make sure what we're providing to you is as useful as possible. Thank you.
Thank you. Yeah, we'd appreciate feedback on scope 1 and 2 emissions, especially, and data fields for scope 1 and 2 emissions reporting. And as we mentioned in the presentation, we're planning to put out some draft templates for public comment by the end of September that would be used or could be used for scope 1 and 2 reporting. I also wanted to mention, with regard to the last commenter on enforcement discretion, we don't make a practice of using enforcement discretion. It's only if we feel it's warranted based on specific conditions. So I did want to add that caveat. Thank you.
Our next commenter will be Andres Verschelden. Please proceed with your comment, Andres.
Thank you.
I'm Andres Verschelden, CEO of Good Lab. We are a California-based sustainability and software company, and we're working with many, many companies who are preparing to comply with the 200s. First of all, I want to thank the folks from CARB for trying to work with this really tight legal deadline that has been given to you. My question relates to 253, and specifically, we're curious about this June 30 deadline, and just wanted to confirm that the limited assurance requirement is to be completed, is due before that June 30 deadline. And if that is the case, then we're wondering if you will accept companies using 2024 data so that they can start their process now. I know you've been pointing back to last fiscal year data, but for many organizations, we worry that if they wait until the beginning of 2026 to use 25-year data, it's going to be really hard to go through the calculations and then also obtain limited assurance before that June 30 timeline. Thank you.
Thank you, Andreas. And yes, limited assurance would be required for that data. And so we appreciate feedback that you have in your written comments on the feasibility of that due date. Thank you.
All right, our next commenter will be Miles Davis. Miles, please unmute yourself and proceed with your comment.
Yeah, thank you so much. I'm Miles Davis. I'm Decarbonization and Environmental Programs Manager with Porsche Cars North America. My question's for SB 253. Are we required to report scope emissions 1, 2, and 3 being emitted in the state of California only, or emissions across entire US operations?
Thank you for the comment. We'd appreciate your feedback on what makes sense with regard to the scope of the emissions reporting. And again, we're going to put out templates by the end of September for scopes 1 and 2 at least.
Yeah, our next commenter will be Dr. Akima Cornell. Dr. Cornell, you've been unmuted. Please proceed.
Hi, thank you very much. Dr. Akima Cornell, Akima Consulting, LLC, a sustainable consulting firm working with clients on their sustainability plans and reporting. Thank you very much for this workshop. It is very helpful to get this additional information. We also appreciate the acknowledgement of good faith efforts for companies that are very new to this process. I'm seeking clarity on a few items. Thanks to Megan Bloomer, who already asked one of my questions, so I'll build on her question. Does CARB have a list of accredited verifiers in case we want to reach out to those individuals for support or additional questions? Second question, can Assurance for 261 be a consulting firm that is working with their clients to develop their reporting process, or does it need to be a completely independent third-party entity? For example, am I allowed to provide assurances for my clients, or the fact that I am working with them already provides a conflict? Thank you.
So we do not have a list of accredited verifiers posted at this time for this program. I want to see if any of my colleagues want to jump in to add to that.
Yeah, I can jump in. So CARB is not planning to do its own accreditation of assurance providers for this program. We want to leverage the existing marketplace for folks that are already in this space. In terms of can you do your own? I think there are a couple of slides in the deck that talked about impartiality and what that means in our existing framework for verification. We're looking for impartiality here because that would be the most consistent way to do what is required in statute, given the plain reading of the statute. It would be hard to make the case that somebody who is in a company helping to actually develop documents and processes and procedures in a company could also then turn around and provide an impartial review of the submitted data to CARB. So I would direct folks to look at what we have in our mandatory reporting regulation on impartiality, because we are looking to leverage that similar framework here. Thank you.
Our next commenter will be Alfie Mahmood. Please unmute yourself and proceed with your comment.
Yes. Can you hear me?
Yes, we can hear you.
All right. Thank you. Yeah, my name is Alfie Mahmood. I'm a general practitioner in this area, not representing my employer's opinion or position. I think this has been asked in different contexts, but I'm going to ask it again. My company's fiscal year is January 31st. Our climate disclosures are on a calendar year basis covering the prior calendar year. For example, our FY26 climate reporting will cover calendar year 2025. Will that be a problem? Are you still there?
Still here. Yeah, wanted to see if Haynes was available to address that question.
Sorry. Yes. Just clarifying that in the statute of 253, again, emissions are to be compiled by the previous fiscal year and reported in the following fiscal year. And then that for 261, calendar year data is permissible, as we are, it is not defined in the statute what sort of time span to use. Hope that helps.
Okay, our next commenter will be Jeet Radia. Jeet, please unmute yourself and proceed with your comment.
Thank you very much. Thank you to all the CARB staff for for this workshop. It's been very helpful. I represent McQuain Corporation, and I'm going to ask a question that I apologize for because it's been asked several times, but I still don't have a clear understanding. So for the 2026 253 reporting, does that have to be an accredited verifier and an accredited assurance body or not? Thank you.
Hey, good morning. Yes, just confirming again. So the reporting, I believe in the first year of the reporting, there's limited assurance is required. And so that would apply to that June 30th deadline that we're proposing here. We'd appreciate your feedback on that.
Thank you. Our next commenter will be Shuangjun Wang. Please unmute yourself and proceed with your comment.
Thank you so much for taking the time today. This is Shanjin Wang, outside counsel, not representing my firm or any client of the firm. Just had three, hopefully, general questions today. So the first is, a number of companies already include climate-related financial risk disclosures in existing reports, whether it's SEC filings or broader sustainability reports posted on their websites. So for purposes of 261, my question is whether companies can submit a link to those existing reports as long as it has the required information, or whether it needs to be a standalone report that only includes the disclosures required by 261. My second question is, I know on one of the slides today, there was a timeline for the implementing fees regulations to be published in mid-December. Does that timeline also apply to the implementing regulations across the board for the 200s? And then my third question is, for 261 reporting with the Jan 1st, 2026 deadline, for this first year, does that still need to cover the prior 2 years of reporting? So calendar or fiscal year 2023, 2024, or only the most recent available information, in other words, only fiscal year 2024? Thank you so much.
Thanks. We'll try to tackle these, and others can jump in to supplement as needed. There was a lot there, so bonus points to you for getting that all in less than 2 minutes. So I believe your first question was related to your clients that may be producing existing reports and putting them on their website. Great. That's great news. Just to put a finer point on this, the enabling legislation here outlines a couple of different voluntary frameworks that need to be applied or followed. So that's TCFD, IFRS, or other international standards, provided that they meet TCFD or IFRS standards. So, in the case where an existing report covers the material asked for in any one of those voluntary frameworks that are covered, that would meet our needs. And so then the subsequent follow-up requirement for us would be to then let us know where to find those reports on the company's websites. Second question was related to the fee reg going to the board. That'll be going to the board for approval in December. So it's a formal board process. It involves public comment, opportunities to weigh in there. And I believe your question is around, is that related to the implementing regs associated with the 200s? I think the most important part, and one of the reasons why we're really trying to focus on these definitions around like revenue, doing business in California, parent subsidiary, that kind of thing, is that those will all be defined for purposes of the fee revenue or for the fee regulation, but also will be putting a finer point on who is in and out of these requirements, per 253 and 261. So that's why we're really trying to focus everyone's attention on these definitions, as they are very foundational to the whole effort, not just the fee regulations. I think your third question, the overall theme, I think related to 261 is like, in a nutshell, which years would we like to see? We would love to see the most recent data available for the company as it exists. I think there's been some confusion on this because we've heard from some companies previously that, maybe the most recent data they would have would be for 2024, and then would that be okay? So we've tried to provide clarity that yes, please use your more recent. You're working with, more sophisticated corporations who, gather this data more frequently and will have data for 2025, then we would love to see that. So basic rule of thumb is use the most recent data for the 260 run reports for the upcoming January 1.
Yeah, our next commenter will be Surya Ramakrishnan. Please unmute yourself and proceed with your comment.
Hi, how are you guys today? I am Surya Ramakrishnan. I am representing Stryker Corporation. I just have two questions for this specific call. One regards scenario analysis. One of the guidances from TCFD is that we have scenario analysis to inform our 261 disclosure. Specifically, our company does not refresh our scenario analysis every year. How up to date do we need this information on scenario and predictive analysis? And if you have any guidance for that. And then my second question is regarding the FAQ sheet. I read that one of the decisions was that you guys are going to be basing enforcement on good faith effort. How is good faith effort defined, and how is that going to be enforced?
Thank you so much. And congratulations for only having two questions. You broke a string of everyone having three questions, so appreciate that. Just kidding. You guys can ask all the questions. Your first one was related to scenario analysis in the 261 report and how often you need to refresh. One of the things, it sounds like your company might not be in this specific situation, but one of the things that we have heard, kind of between the last workshop and this workshop, is we've heard from a number of companies who are doing these climate-related financial risk reports for the first time ever. So one of the things that they have flagged for us is like, hey, we can probably do scenario analysis in the future, but for this first one, we don't think we have the capacity to do it. So one of the things you probably saw in the draft guidance that we're planning to put forward for 261 is, hey, if you've got it, that's great. Love to see it. If you can't do it for this initial Jan 1 report, that's okay. It's not going to be part of the minimum requirements that CARB is looking for. So If you have it and you're on top of it and your company is ready to share it, that's great for this first report. If not, it's not going to be it's not proposed at least to be part of the minimum requirements for this initial report. Second was related to good faith efforts. The way we've been talking about this is basically based on data. So that's why we keep coming back to most recently available data. So good faith for us really correlates with data. Hope that's helpful. Thank you.
All right, our next commenter will be Gabriel Trevellino. Please unmute yourself and proceed with your comment, Gabriel.
Thank you, Paul. Hello, everyone. My name is Gabriel Trevellino. I work at Ambipar, which is a Brazilian environmental solutions company that provides GHG inventory reporting services worldwide. Could you, my question is, could you clarify whether the regulation requires independent third-party assurance providers to be accredited directly by CARB?
So we are not going to do an accreditation process for assurance providers for this program. We are going to leverage existing mechanisms and frameworks to do those kinds of accreditations, and we will ultimately recognize those in our regulation. So there is already standards for how to report scope 1, scope 2. There's information in there and guidance in there on how to get assurance providers. There's a lot of assurance providers that are already providing these services out there. And so we're going to leverage what's already out in the marketplace. There is no requirement for a CARB accredited assurance provider now, and there will not be in the regulation.
Okay, our next commenter will be Adenike Akindoli. Please unmute yourself and proceed.
Yeah. Good afternoon. Adenike here from Coca-Cola. I just wanted to ask if we already have a voluntary report that we're publishing on our company's website. Can we reference that for the 261, or do we, or some parts of it, as the case may be, or do we need to still have, like, the 261 as a standalone report? That's one. And then two, for 261 for year one, for the metrics that we're disclosing in terms of the scope 1, scope 2 emissions, are we required to include scope 3 as well if we're already disclosing, or do we just disclose scope 1 and 2? And I'm also sort of wondering, do we expect the data we're reporting for 253 for next year to sync up with 261 at some point, since that it looks like we're going to be using different calendar years? Thank you
so much. Okay, I think I can take a stab at a couple of these. Others feel free to jump in. Your first question was basically along the lines of your companies may already be doing voluntary reporting. Can we point to that as part of meeting our requirements for 261? That there's a couple of if statements that I think go along with that. If those reports are consistent with the legislation, with the enabling legislation of 261, then yes, 261 points to specific voluntary frameworks that can / need to be used. So TCFD 2017 or subsequent iterations, IFRS, and then there's kind of like a other category, and I'd refer you to the health and safety code on that one. So if your reports, encapsulate or follow those directions and methodologies, yes, then please report that to us. If they don't, that's where I think the answer to your question gets a little bit more complicated in terms of in terms of what you would need to do to comply. You would need to make sure that your reports, meet these voluntary standards. We've also, as part of what we're doing today, we're trying to put out draft minimum guidance for basically the bare minimum that CARB would be looking for in these reports. So I'd refer you to that as well. Your other question was related to 261 and metrics and targets. metrics and targets are referred to as an important piece of reporting under both IFRS and TCFD. And both of them recommend reporting scope 1, 2, and 3 where material. We heard from a number of companies between the last workshop and this one that reporting scope 1, 2, and 3, wasn't necessarily feasible. So it's not going to be part of the minimum requirements that CARB looks for in this initial report that's due Jan 1, 2026. But however, we do say that if your company is already collecting those and if it's material to the analysis in your 261 report to, of course, please include it. Thank you.
Our next commenter will be Janica Kramer. Janica, please unmute yourself and proceed with your comment. Janica, if
Hi.
you're, oh,
Can hear you now. Thank you.
now we can hear you. Yeah.
Great. So my name is Yana Kramer. I'm a senior sustainability analyst at GSI Environmental. We're an environmental engineering and sustainability consulting firm here in California. So thank you for your presentation. I have a very specific question, and I believe you may be answered, but I want to confirm. It relates to the current clients of ours that are diligently preparing their climate management programs and disclosures. And if a company has started its climate risk assessment and plans to use that assessment as input to complete their scenario analysis in 2026, would that meet CARB's expectations for a good faith disclosure under SB 261, or is the expectation to have that qualitative CSA completed before the 2026 disclosure deadline? Thank you.
Okay, so I think I understand the question, which is, working on the 261 climate related financial risk report, are in a quandary maybe on scenario analysis, and is qualitative discussion okay versus quantitative discussion, as part of the draft guidance that we're proposing to put out. It does say that if qualitative is the thing that's available to you, that will meet our minimum expectations or minimum requirements for this first report coming up that's due Jan 1, 2026. Of course, if something quantitative is available and material to your company's analysis, of course we want to see it. We're just trying to provide a glide path to companies that may not be as far along in the process in terms of developing these climate related financial risk reports.
Okay, our next commenter will be Brady Coding. Brady, you've been unmuted. Please proceed with your comment.
Hello, can you all hear me?
Yes, hear you just fine.
Great, thank you. So my name is Brady Ketting. I also work for GSI Environmental as a senior sustainability auditor. And I'm looking to just get some clarification over the evidence you all can see being required to ensure that SB 253 disclosures are verified. Basically, in other words, do you envision verifiers providing a verification letter as part of the disclosure? Are you all considering requirements for the wording of those verification letters? And then are those verification letters to be published along with the SB 253 disclosures? Thank you.
I'll just say that as part of the workshop today, we're trying to collect responses and input as to the best ways to proceed when it comes to assurance and verification. We put out some, initial staff thinking on this, but if you have specific ideas about how best to proceed, we're very interested in taking those comments. If written comments easier, that's great too.
All right, our next commenter will be Jayung Jeon. Please unmute yourself and proceed with your comment.
Hello, can you hear me?
Yes, we can hear you.
Hi, my name is Jayang, and I'm not representing anyone today. I have a couple questions regarding the applicability of the 200s. My first question is, if there is a company that has its principal place of business in California, and this company has a parent company or a subsidiary that is a non-US entity, could I understand that the revenue of such non-US parent or non-US subsidiary is not included in the calculation of the revenue? And my second question is, in the case of a non-US company that has no presence in California, but they still have revenue arising out of California, could I understand that the 200s do not apply to such non-US company?
Yeah. So as part of the process, we're trying to take comment on a couple of key definitions. That includes both revenue and doing business in California. Questions around revenue are, and for us, out to folks, is whether or not the definition provides the certainty that you need to determine whether or not your company meets the revenue thresholds. If we haven't gotten it right necessarily or unclear, we're interested in public comment to help refine that regulatory definition. In terms of presence in California, current staff proposal is to define that based on the presence of on the Secretary of State businesses, a list that we talked about earlier in the presentation. If that is useful or not useful, or we should consider another definition. We're looking for input on that as well.
Okay, our next commenter will be Sarah Quintal. Sarah, please go ahead and proceed with your comment.
Great, thanks so much. Sarah Quintal, WSP USA, Global Sustainability Consulting Company. A few questions related to 261 specifically. I realize there's been several questions about time frame, but given the scenario analysis component, I'd like a little bit more clarification on, for example, if a scenario analysis was completed in 2022, for example, would the risk assessment that results from that suffice for SB 261? Secondly, what should be reported should a company determine it does not have material climate related risk? And third, to keep with the rule of threes, can CARB provide a time horizon for when to expect this guidance on meeting minimum requirements for compliance? Thank you.
Okay, thank you for doing rule of threes. Loving this theme for us today. In terms of the time horizon, consider today and the slides today to be the first step at giving minimum CARB draft guidance for the minimum requirements we're looking at to fulfill the 261 requirements. So if folks have comments on what we've put forward today on whether or not the minimums that we've put out there are appropriate or not appropriate, that would be useful. Moving backwards, I think your second question was related to, hey, what if we don't have material climate related financial risks? One of the things that we are proposing to put out there as a minimum is that these reports include a description of why not different risks or actions taken to address those risks have or have not been included. I would assume that description would fall into the category of what we're talking about. And then lastly, on scenario analysis, I know there's lots of angst around scenario analysis, and that's one of the reasons why, we're saying that if you are able to do it, if you have it, if it's material to the report that you put into the Jan 1 2026 report, that is great. But it is not a requirement in terms of minimum CARB expectation for this initial reporting. We understand that some companies may need time to ramp up or gear up. And it sounds like maybe in your case, that these scenario analysis may be not done as frequently to align with Jan 1 2026. So scenario analysis, for the first one, it's like a nice to have, but if you have it, of course, we want to see it.
Our next commenter will be Mallory Andrews. Mallory, please unmute yourself and proceed.
Hi, everyone. Thank you for today. I work for Cameron Cole. We are a verification body in the U.S., ISO accredited, and also under California. So I have one question and then a couple comments, so you don't need to respond live. My question is regarding your slide of the assurance standards. Will you be selecting one of the standards that all of your VBs will need to be accredited to, or will there be a selection list? So as long as a VB is accredited to one of the items on the list, we're good to go. A comment would be, as a VB, it would be helpful to have clarity on whether the reporters are going to be able to disclose de minimis emission sources, acceptability of any estimates, and if there's a threshold there, materiality thresholds for the verification or assurance process, and then a disclosure of any known exclusions. A lot of these companies have sources that are very challenging to calculate and will knowingly exclude them. So if there's a disclosure for that. I'd also like to just reiterate that some comments, I think Connor Merrigan, so he was saying that the tiered disclosure deadline, so June 30th as the implementation deadline, it would be really helpful to have towards the end of the year for assurance. So a tiered implementation and then verification deadline, and then also any kind of formal accreditation list of verifiers or assurance providers that CARB could provide so that there is transparency for that process. Thank you.
You very, very helpful. I appreciate it. Okay, so first one for assurance standards. Yes, we're looking for, of course, more than just one. We're looking to take advantage of the different accreditations that are out there. The list that we gave today is the initial list that we're aware of, but if there's others that we should be thinking about including, please let us know. Second theme was around de minimis thresholds. If there's specific examples you could give us, potentially in writing, that will be helpful in terms of informing our thinking on this. Thank you for your comments regarding known exclusions and the tiered deadline concept for scope 1 and 2. Very helpful. Thank you.
Our next commenter will be Raquel De Leon. Raquel, please unmute yourself and proceed with your comment.
Hi, can you hear me?
Yes, we hear you great.
Okay, great. Okay, a couple of questions. The first one is, if the parent company is based in California and meets the SB 253 revenue threshold, does that automatically bring all subsidiaries, regardless of location, into the scope of reporting? Given that most of our subsidiaries are located outside California, can we choose to report as at the consolidated company level and pay a single annual fee rather than reporting and paying separately for each subsidiary? So that's the first question. The second question is, can we satisfy SB 253 June 30 reporting requirement by submitting a CDP report that uses 24 data and includes limited assurance? If so, does that single CDP report suffice, or can the disclosure be spread across multiple formats, such as a CDP report, website posting, or inclusion in a 10K filing? Additionally, if the CDP report is based on the TCFD 2017 framework, do we need to make it public, or as long as we have the report, that's good? And another question is, a third-party assurance for SB 250 reporting required even if CARB hasn't issued yet specific guidelines? Should we wait to engage an assurance provider until more specific guidelines are put out there? And lastly, scope review reporting under SB 253 begins in 2027 using data from calendar year 2026, which is coming up in a few months. However, we haven't seen any formal requirements published yet. Will CARB release detailed guidance before then? So sometime this 2025? That's it. Thank you so much.
I appreciate it. Okay. Let's just do like a general time note. My recommendation for folks is that if you have not reviewed the existing materials that we have put out to the state, that I would recommend that instead of asking these questions, that you do take a look at those things so that we can be respectful of everybody's time. I also think some of these questions are starting to muddle 253 versus 261. So I want to be clear that 261 lists a number of different voluntary frameworks that are allowable if you're reporting through different entities. The onus is on you to really make sure that your reports meet those voluntary standards that are set by 261. So my other, I guess, public service announcement would be to, when you're asking us questions, please clarify whether we're talking about 253 or 261. We'll be able to get more pointedly at your questions. I'll just note there's about 59 more hands up. I'm not sure if we're going to be able to get through all of these today. If you're not familiar with our materials, I'll just ask that you yield your time. Thanks.
Okay, our next commenter will be Lexi Haskins. Please proceed with your comment.
Hi, thank you. I'm Lexi Haskins from Rakuten International. So I wanted to ask around the parent subsidiary clarification and understanding if it is still up for comment. So to ensure that we are meeting our upcoming deadlines and allocating our resources effectively, could you please clearly clarify the reporting eligibility for the international parent companies under both 253 and 261? So it's essentially asking, like, can the international parent company file this single consolidated report, or is the California-based subsidiary required to file its own report separately for all of the US subsidiaries? Thank you.
Yeah, thank you. What I am picking up on is there's a number of kind of questions about this gray area in the parent subsidiary relationship. If you and others would not mind, submitting, some quick written comments, whether it be a formal letter, or just a quick email to our climate disclosure email, I think that will help us parse through these different kind of gray areas, and we'll likely be able to provide, more details on how to parse through this. But I'd like to try to get them together in one place, because we're certainly getting a lot of those today. So I hear the need.
All right, our next commenter will be Danielle Weeder. Please unmute yourself and proceed with your comment.
Hi, Danielle Weeder. I'm with Meta Platforms. Thank you for all the updates and presentation. We're seeking clarification from the earlier presentation on the minimum disclosure requirements for SB 261. The latest published bill language includes both two requirements. So one that you went over to disclose in accordance with the recommended frameworks, all clear on that, but I was looking for clarification on the second published requirement for entities to disclose its measures adopted to reduce and adapt to climate-related financial risk. Looking for clarification if that second requirement will remain in the final language, or if that's been decided on. Second question, if so if it is in the final requirement language, will it apply only to material climate-related financial risk, or would that requirement apply whether or not the entity is disclosing material climate-related financial risk?
So in 261, there's language that allows for the reporting of investments and actions to reduce GHGs that may not necessarily be under direct operational control of the company that's subject to reporting or the subsidiary subject to reporting. That voluntary piece we're going to allow to be included in reporting to or included in your reports that are posted on the company website that we will then have links for on the CARB website. In 253, it doesn't include similar language, but we know that there are many companies that are going to be in 253 that are also already under compliance regulations at the state, whether it's at CARB or one of our sister agencies. They are already subject to reporting. And what we allow there is the reporting of other activities like renewable energy credits and green attributes, where they have paid for those green attributes from things like renewable natural gas. We want to be consistent, and we want to support that our existing programs for compliance on reductions which recognize those kinds of investments, that same opportunity for disclosing those kinds of investments is also made available under 253. Now, 253 doesn't have a specific way under the GHG protocol to report those kinds of activities, but we are going to add a table or a process by which those kinds of activities can be reported. They won't be netted against any emissions, but they will be there for a more comprehensive picture of what is happening for the emissions from scope 1, scope 2, scope 3, and any other things that companies are doing for compliance with regulatory programs, such as our low carbon fuel standards, such as our electricity programs, and our cap and trade programs.
Okay. So we still have about a little over 40 hands raised. Staff are able to continue taking questions until 1 p.m. and then we'll have to end the webinar. And so once again, we encourage you to send us written comments through the public docket, which is now open on the webpage and will be open for 3 weeks. And we will read through all of those comments. So our next commenter is Alyssa Zucker. Please unmute yourself and proceed.
Hi there, Alyssa Zucker from Workiva, echoing everyone's appreciation for your time and thoughtfulness and patience with us as we ask many questions of different flavors of the same thing. I'm afraid this one follows suits, and I just want to clarify here. I heard throughout other questions asked that under SB 261 reporting, if you're following TCFD, that CARB will not consider as the minimum requirements scope 1, 2, 3 emissions reporting under that law. And so I just want to reiterate that because we get a lot of questions from our customers about this, that if you are following TCFD recommendations for your SB 261 climate risk reporting, that you do not have to follow Part B of the metrics and targets part and disclose your emissions. And so I suppose a broader question there is how prescriptive in following the TCFD recommendations and the ABC style breakouts that they give under the 4 different pillars should companies be if emissions disclosure is not included?
Yeah,
Thank you.
thanks, Alyssa. Appreciate it. So what we're trying to do with the minimum guidance that we started to put out today via draft is we really heard a lot of comments from a lot of companies who have not done this type of work before, that there were several items within TCFD that would be very hard for them to ramp up between now and Jan 1, basically, to accomplish. So for this first reporting cycle, there's a couple of buckets of things that we heard from folks that would be hard to accomplish. So what we're trying to say is for this first initial reporting requirement that is part of the minimum items that CARB is looking for, scope 1, 2, and 3, and scenarios analysis won't be necessarily things that will need to meet, minimum CARB expectations. We're still taking comment, this is the first time we've talked about these draft guidelines, so we're still taking comment on whether or not we've got it right. But under the draft guidelines, then, companies who don't have that information, would not need to report it. If a company does have that information and it's material, to their climate related financial risk disclosure, then the answer is of course. What we're trying to do is recognize that not all companies are in the same position in terms of being able to develop and generate all of that right now.
Our next commenter will be Michael McDonough. Please unmute yourself and proceed, Michael.
Hi, thank you. Yeah, it's Mike McDonough. I'm from Pillsbury in Los Angeles. Just a quick question on the doing business in California definition. Is it CARB's intention to make the 23101B criteria from the tax code? So, commercial domicile or sales, employee, or real property thresholds. Is it the intention to make those criteria be the determinative test for doing business in California, or could a company possibly be deemed to be doing business in California even if it doesn't meet one of those criteria? So for example, you guys have mentioned if you've got a registered agent for service of process in the state, if you've got an agent regardless of meeting those thresholds in 23101B, could you still be doing business in California? Or if you're, sort of otherwise actively engaging in transactions for financial profit in California, could you still be doing business without meeting those 23101B criteria?
Yeah, this is exactly what we're looking for feedback on. So, we've kind of looked at two different places to try to establish, what regulatory definition would make it clear as to whether or not a company is in or out of our regulation by virtue of, quote, doing business in California. So one option is, pointing to the existing tax code. The other option is, looking to presence on the Secretary of State um, site and using that as a proxy. I think our question is, we're looking for feedback as to, for the purposes of our regulation, is there a preferred path forward? And is it either of those two? Is it some third option? But we're looking for feedback on just this relatively quickly, because the regulation will be going to the board at the December board meeting.
Okay, our next commenter will be Suleiman Ahmed. Please unmute yourself and proceed with your comment, Suleiman. Suleiman, if you're speaking, we cannot hear you. Please unmute yourself.
Hello, thank you, sir. Can you hear me now?
Yes, we got you.
Thank you for the time. So I'll make this quick. I'm from National Grid, and I just wanted to clarify for the next bit of documents that are going to be released. It sounds like you're planning to potentially release a preliminary analysis list of the companies that would be covered in a few weeks. I just want to confirm that, and if there's a little bit more definite timeline there. And then the second was I heard that would be releasing templates for what would be expected for scope 1 and 2 for SB 253. So I just want to clarify those points. Thank you.
Hi, Solomon. Yes, so just to confirm, we are going to release that list. I don't have a more definite time frame for you, but hopefully within the next 1 to 2 weeks. And then the scope 1 and 2 reporting templates, we're looking to get those out before the end of September. And that will also trigger a public comment period.
Okay, our next commenter will be Olivia Fisher. Please unmute yourself and proceed with your comment, Olivia.
Yes, Olivia Fisher with Cal Portland. I was calling to see if CARB had considered aligning the 253 deadline with the MRR reporting deadline, considering that some companies have facilities reporting under that program currently, and the verification of that data is not due until August. And throughout the verification process, there may be things identified that need to be updated or corrected. So if we are reporting for 253 prior to that deadline, we may now have two conflicting sets of data submitted to CARB. And if not aligning those two deadlines, will there be a provision to allow for updates to previously submitted 253 data to reflect those changes? Thank you.
Thanks, Olivia. Appreciate the comment there. And please provide that feedback in writing and any other details you can provide there as far as recommendations go.
Thank you. Our next commenter will be Tyler Aguilar. Tyler, please unmute yourself and proceed.
Thank you, everybody, and thanks for the webinar. Tyler Aguilar with the University of Southern California. Just want to quickly comment that USC appreciates CARB's thoughtful approach to implementing the 200s as we're referring to them now. We generally support CARB's recommendation to exempt nonprofits, including nonprofit universities, from these disclosure requirements. We believe this proposed exemption is consistent with the legislative intent of the statutes, and we look forward to reviewing the draft regulations. Thank you.
Great. Thanks, Tyler. Thanks for giving the branding of the 200s a shout out.
Our next commenter will be Joseph Sturer. Joseph, please unmute yourself and proceed.
Hello, yes. My name is Joseph Steyer with York Engineering. We provide greenhouse gas and LCFS verification services in California, Washington, Oregon. We've also done scope-based verification reporting and voluntary scope-based limited assurance for clients as well along those lines. Just two comments real quick, more than questions. First one, for SB 253 reporting, since that's based on the fiscal year, I think probably just make most sense to have a deadline based on days after the end of the fiscal quarter than a one deadline for reporting all the facilities at the same time, and also make sure that enough time is provided after that reporting deadline to allow for assurance as well. And also considering not putting that same deadline as other California deadlines, because a lot of similar facilities will do both along those lines, but things to keep in mind for deadlines for next year. And then for my second comment for limited assurance is just that I know that California won't offer theirs, but just to make sure that, since there could be like 2,500 companies, and I don't think currently, if you review, there's enough limited assurance companies that can do enough limited assurance that are accredited through ISO or ANAB or other things to at least allow some time or like people that have experience doing mandatory verification or other things to do limited assurance until more entities can get those outside limited assurance verifications, especially something like ISO can take a long time and a lot of expense to get those certifications. Thank you.
You really appreciate your feedback.
Our next commenter will be Laura Valdez. Laura, please go ahead and proceed.
Thank you. Thank you for taking the time. I'm Laura Valdez with Jans. Regarding SB 261, are reports going to be evaluated for completeness and accuracy so companies receive feedback and improve on these disclosures? Or what constitutes good faith efforts for the first report versus what you might expect on a second report? Thank you.
You appreciate the feedback for the 261 reports. We as part of today's workshop, we did put out draft staff's proposal for minimums to meet, and the first report's due Jan 1.
Thank you. Our next commenter will be Tara Jankowski. Tara, please unmute yourself and proceed with your comment.
Thank you. Hi, this is Tara from ADEC ESG Solutions. We are, one of the consultants that help a lot of the bigger companies meet these disclosures for short and long term. So I feel like this has been covered a couple of times, but I'm not getting clear guidance on. So the bill text says TCFD or successor. Since TCFD has been disbanded, at what cycle can we count on that we will evolve into IFRS, require scenario analysis, because our clients are asking us this so that we can plan ahead over the next few years. So I don't want to detract from this current rulemaking, but I also think it's important to look long-term so that we can help advise our clients in their long-term strategy. Thanks.
And just to be clear, in 261, there are a number of different voluntary frameworks that can be used, TCFD or successor, IFRS, or kind of a third catch-all. We're just putting out draft minimum guidance for what CARB will be looking for during this initial cycle.
Okay, our next commenter will be Jacqueline Moore. Jacqueline, please unmute yourself and go ahead.
Hi, thank you so much. Glad I had the opportunity to give this comment, given there are so many others that participated today. So Jacqueline Moore, PMSA, representing vessel carriers and marine terminals that operate on the West Coast. Obviously, being international in scope by nature, we have a number of concerns and questions on parent and their subsidiary, but I'll save that for our comment letter because they're quite specific. But did want to just seek clarification on, 253 allows the existing reporting standards, such as the GHG protocol. So my question is, can whatever that is already reported or done, perhaps under EU, specifically for us, the EU rules, can those be submitted for 253 such that all the entities that are eligible for this program could potentially be submitting different formats? Or are those reporting templates that CARB is anticipating to release here shortly soon for reactions? Will those be required instead? Thank you.
Thank you. In short, the latter, but we are looking for feedback on what data fields would be most useful for scope 1 and 2 emissions reporting. And obviously, we're looking to align where possible. So having informed feedback for folks like yourself who are reporting in these other contexts as well as to, what data field reporting is best or most streamlined is, of course, very welcome.
Our next commenter will be Jonathan Kendrick. Jonathan, please unmute yourself and go ahead.
Good afternoon, John Kendrick on behalf of the California Chamber of Commerce. I'll keep it brief today. Just I think a lot of comments that you've heard today have focused on flexibility in timing, feasible reporting timeframes. Certainly echo those. Do you have a couple questions for you? Since CARB is by far the most experienced agency when it comes to performing standardized regulatory impact assessments, could you speak a bit to the benefits of performing that type of assessment? And then also, I mean, the compliance costs of these programs are absolutely massive. Do you intend to perform SORIA for both of these rulemakings? Thank you.
Jonathan.
Our next commenter will be Stephen Grover. Stephen, please go ahead and unmute yourself and proceed with your comment.
Hi there, Stephen Grover representing myself today. I was following up on some questions that have been already asked about working with TCFD for SB 261. An entity would provide scope 1 and scope 2 for their year in the metrics and target section. Now, assuming that entity is also subject to SB 253, how do we mirror the 261 values with the 253 values? And can the entity omit the scope 1 and scope 2 values for SB 261 if they don't have them? I think you all have said yes, but just want to confirm that. And should the TCFD report align with the fiscal year of the SB 253 reporting, or can they differ with the TCFD report being a calendar year and the 253 being fiscal year?
Okay, I think I could knock out a few of those. Okay, so for 261, I think your question is around scope 1, 2, and 3. And if they do have them, what do you do? If you don't have them, what do you do? Or in the case where they do, that information does exist, then of course, to the extent that it's material to the analysis in 261, of course, that should be included per the TCFD 2017 and subsequent iterations guidance if it's material. So, the threshold for what to include in 261 is really kind of based on the voluntary frameworks and the guidance around that's currently set up. So that's how I think about that one. If you're working with a company who maybe doesn't have it or is not as further along in developing a climate-related financial risk report, what we're saying today as part of our draft minimum guidance is that our proposal is, if that's not something that a company has in time for the Jan 1, 2026 report, that we're not going to be looking for it as a minimum requirement.
And I can hop in just again on the reporting deadlines. As you mentioned, SB 61 has a January 1st reporting deadline for 2026, but we also are looking for reporting entities to use best available data. And so if that best available data and that most recent best available data is on a fiscal year timeline, then that is permissible for the first year reports, and further guidance on that will be sort of provided as the next round goes.
Okay, our next commenter is Charles Lee. Charles, please unmute yourself and proceed.
Thank you. My name is Charles Lee, representing Trinity Consultants. We are an environmental consulting company as well as a verification body under the CARB mandatory program, as well as mandatory reporting program, as well as low carbon fuel standards. And we are actively engaged in providing third-party assurance verification services in California and Oregon and Washington, as well as the voluntary, the market. So my question is stemming from, or comments or questions is coming from the concern that we have existing mandatory programs currently in play in California, Oregon, and Washington that has overlapping time frame in terms of the requirements of completing the verifications. So the verification process usually April through September each year. The verification existing program requires the verifiers to engage and do the work. Considering that there is about 2,600 companies that per your assessment that would require a limited assurance verification services in the marketplace. But if the reporting deadlines is in June, my concern is about the lack of basically resources and time frame that's available for verifiers to complete and meet the objectives.
Thanks for your input on that. We appreciate it.
Hi, Charles. Thanks for your question. I would encourage you to submit a comment with your, with your concern, a written comment, and maybe we can follow up on this question since it's fairly specific to your company, and then we could sort of dive into that issue a little bit more. Thank you.
Okay, our next commenter will be Suzanne Bilodeau. Please unmute yourself, Suzanne, and ask your comment or make your comment.
Hi. I'm with a local amusement park, and we have an entity. Our parent subsidiary, or our parent company, is out of state. We have 4 locations here in California. I'm not sure if any of us individually would reach the thresholds for the different the monetary requirements for 253 and 261. So is each subsidiary reporting independently, or is it based on a the parent company total? And how does that work? Is it just, it's just California emissions? It wouldn't be other locations as well? Does that make sense, my question?
Yes, it does. Thanks so much. I appreciate it. We're also, based on where we're all speculating you work, we're volunteering you to host our next Insight workshop. I hope that's okay with you. Okay, so in terms of whether or not your specific entities would fall into the scope, I think that will depend on a couple of things. So it'll depend on how these definitions of revenue and doing business in California shake out. So I think those will be really critical for us to be able to, fully answer your questions. Under the statute, they kind of have to meet those 2 check boxes. US-based company doing business in California. The parent subsidiary conversation has been coming up in kind of a different context because one of our enabling pieces of legislation allows for a parent company to report emissions on behalf of its subsidiaries at that higher parent level. We'll also be coming out with our list of who we think has the revenue thresholds and who is doing business in California. We'll be coming out with that list in the next couple of weeks. So I encourage you to take a look at that and see if that helps refine further. If we need to have follow-up conversations, on these specifics, I'm sure we'll need to do that with lots of folks. So would encourage that.
Our next commenter is Jason Langford. Jason, please unmute yourself and proceed.
Thank you. I appreciate the time. My comment sort of follows up on the prior comment as well on the question of doing business in California. If I'm hearing correctly, it sounds like you are saying that under the staff's current proposal on which entities will be subject to the 200s in a parent subsidiary chain where the parent is US but not California based, your current proposal would capture only subsidiary entities that are registered in the California Secretary of State Business Entity Database or whatever other database you use to identify entities that independently meet the revenue threshold. So in other words, if there's a subsidiary doing business in California with under 500 million in revenue, and then it has a US based parent, not California based, but US based parent that does not do business in California, but which parent has revenue over 1 billion, it's a subsidiary, an in-scope entity. And would the parent also be an in-scope entity? Now, if my understanding is correct, and that you're only looking at the individual subsidiary that does business in California and not the parent, but then if only the parent reports and only at the consolidated level and the subsidiary has to report, would the parent's consolidated report be acceptable for the affected subsidiary? And then my last question is concerning SB 261 and the public docket that you are going to create. Will posting a link to the 261 report on that docket be mandated by the regulation? Thank you.
Thanks, Jason. Taking your easiest first, yes, you must report where the 261, where we can find your 261 report. We need to be able to follow up and verify compliance with 261. In terms of the hypotheticals discussed earlier, really encourage you all to put these parent subsidiary questions in writing. I imagine there's a lot of gray area we're going to need to navigate. So please put the situation scenarios, into, whether it be a public comment letter, email to climate disclosure email. That would be very helpful for us so that we can help figure out if we need to do something to, refine the definitions that we've, put forward for the regulation or take a different tact.
All right, the next commenter will be Richard Chandler. Richard, I've unmuted you. Please go ahead and proceed with your comment. Richard, if you're speaking, we can't hear you. Please unmute yourself. Okay, Richard, since we're not hearing you, I'm going to move to the next hand up in the queue. Albert Liu, you'll be our next commenter. Please unmute yourself and proceed with the comment.
Hi, can you hear me?
Yes, we got you.
Great. Thank you, Albert Liu from GSI Environmental. We do environmental and sustainability consulting. So my background is that I'm also a CARB lead GHG verifier. And I heard on another response to another question earlier that that CARB was very pleased with how their conflict of interest is set up for MRR, and that the sentiment is that they wish to mirror that for these regulations as well for assurance. So I'm just wondering, are we looking at a one-to-one, or particularly in regards to things like the 3-year turnover of the auditor? Just want to be prepared to give the next forward steps to our clients. Thanks.
Thank you.
Our next commenter will be Ann Sikowski. Ann, please go ahead and unmute yourself and proceed.
Hi, thank you. My name is Ann Sokolsky, representing a company called World Group. My question is specifically on the definition of entity, and especially in the revenue threshold. We are a common ownership but separate entities. So I'm just trying to understand what definition of entity that you're using. Is it legal incorporation, NAICS classification, or ownership structure? So I think having a more definition surrounding entity would really support companies like us, private ownership, where together our entities combined are greater than 500 million, but less are separate. Thank you.
Thank you. Appreciate you bringing that up, Ann.
Thank you. Our next commenter will be Tayfun Diekman. Tayfun, please proceed with your comment.
Thank you. My name is Tayfun Diekman. I am the Sustainability Manager at Actis Nutrition. I wanted to clarify a few different things. This question was asked earlier, but I feel like the spirit of the question was missed with the response. We wanted to know if there was feedback that was going to be given for good faith efforts, since this specifically to 261, that's going to be kind of the basis of the report structure going forward. And so it'd be nice to know if we completely missed the mark, but it was enough for good faith, or if we were in compliance even under the full SB 261 standards. And then there was another comment that good faith effort would be based on the data, but then all the other comments have reiterated that scope 1, 2, and 3 emissions aren't going to be part of the minimum requirements for the first year. So I wanted to just clarify that. And then my last question was, how are we going to verify that the report was uploaded to our website by January 1, even if that the window to send the link to you guys is going to be open greater than that?
Great. I think I can get most of these, but others should jump in. My brain's getting a little tired, not gonna lie, you guys. We may need some follow-ups for some of these questions. Okay, so for Jan 1, the Jan 1 deadline for 261. So yes, according to statute, you must post your climate financial risk disclosure to your own website by Jan 1, 2026. We are trying to be kind and leave the reporting to us window open until later in the year. So I hope that is a helpful thing and not something that causes undue confusion, but we can always shorten that window or also make it Jan 1, 2026 if that's what folks are asking for.
And our
Others
next,
have responses to any of the rest of it. I could use the assist. If not, we can always follow up one-on-one.
okay, we will continue with the next commenter so we can try to get through the rest of these. Norman Wong, please unmute yourself and provide your comment.
Hi, my name's Norman. I'm with Sadali & Co. We're a consulting firm. I'm just going to throw one question and one comment. It's around SB, I know, SB 253. So I understand entities starting 2026 has to report for their prior fiscal year. Can you confirm that January 1, 2026 is the correct reference point for referring back and figuring out what that fiscal year is? And then the comment is, assuming that's correct, that that means that some companies will have just 6 months to collect their information and submit their GHG reports. I think for January 30th, that's fine. But when you add verification to that, that's going to take more time. So I would suggest, sort of echoing other concerns, people's concerns, to push that timeline to maybe at least end of August to also account for that verification time. Thanks.
All right. Thank you for your comment. I can address the earlier question. Yes, your determination of your prior fiscal year could be made on January 1st, 2026. So whatever the prior, most recent complete fiscal year would be.
Okay, our next commenter will be Matt Pigozo. Matt, please proceed.
Hi, thank you. Matt Pigozo, I'm with ITW, and I guess first off, I'd just like to reiterate the June 30. I do think that's kind of early, especially if companies are going through this a first time and there's resource constraints out there to get people to verify your data, and or if you're not using one of those current frameworks that you have listed and you have to switch frameworks and go back and kind of redo work. Personally, I'd say that end of the year would probably be a better deadline, but and then tighten it up in the future as companies get used to doing this annually. And then my question is really on the consolidated report, and I think others have asked this, but I feel like we're getting and this is under 253. I think we're getting a little confused back and forth between the revenue definition and the scope of the consolidated parent company report. So for my company, we're clearly going to be in scope over the billion, and we do have a consolidated report currently, but it's a global report, and it includes operations outside of the United States, outside of California, outside of it includes Asia, Europe, and everything. Is that consolidated global report acceptable to meet the consolidated company reporting? Or when we're saying consolidated company reporting, are we talking about just the US operations or the US companies that report or that do business in California? Or maybe that's one of those open questions.
Got you. I think what I'm hearing is just as a general ask for definitions around not just the reporting entity scope, but also the actual reporting emissions scope. So we'll definitely note that. If folks have a particular suggestion in this realm, we're definitely open to hearing it as well. So yes, thank you, Mike.
Our next commenter will be Susan Nelson Spencer. Susan, please unmute yourself and proceed.
Hi, thank you for taking my comment. I am the co-founder of Blue Sky Climate Reporting Services, a California-based climate and ESG consultancy. I want to thank you for your presentation and for your very great patience with all of our questions. Your efforts as an agency make me very proud to be a Californian. I have one simple question. Can we use 2024 data for, this is greenhouse gas inventory data, for this first round of an entity's SB 253 reporting cycle?
Hi, Susan. For 253, that first report due in 2026 is supposed to be 2025 data.
That's outlined in the statute as well. Happy to follow up with you.
Yeah, I just want to layer in that the staff here is absolutely right. The team that Sid's leading is absolutely right. It's 25, it reported in 2026. That is why the comments related to timing and effort to get the reports through an assurance process are really critical to have on record for us, so we can understand what the implications are and what the business processes are to get data for 2025 ready to be submitted under 253 and have it made or have it go through the assurance process. So that's what we're really looking for here.
All right, our next commenter will be Sarah Mitchell. Sarah, please unmute yourself and proceed. Sarah, are you?
Hi, speaking.
Okay.
I meant to lower my hand because my questions have already been addressed, so I don't wish to repeat what has been asked already.
Sarah, you're a hero to us all. Sarah!
You're welcome.
Thank you so much, Sarah. Glad you were able to get your answers already. Next commenter will be Martin Wong. Martin, please unmute yourself and proceed.
Hi, this is Amanda Boothie. I believe I somehow got entered as Martin Wong. Martin's on my team, but I'm with Georgeson Advisory. We're an ESG advisory firm advising public and private firms on ESG strategy and disclosures. We have one question and two comments. The first question is regarding estimated data for SB 253. We have several clients wondering about the possibility of estimating 1 to 3 months of data at the end of the year in order to allow calculations and assurance to take place on a more accelerated timeline. This would also allow for both calculation and assurance providers to spread out the burden of support across clients, rather than everyone doing so in the same few months prior to the proposed deadline in June 2026. Would estimated data be acceptable, or will you be leaving that decision up to assurance providers and their discretion about what level of estimation would be allowed under their limited assurance practices? My first comment is related to 253 and the scope 1 and 2 disclosure fields. Given the prevalence of CDP, I would recommend reviewing the CDP disclosure fields to avoid creating new burdens on companies that are already utilizing this structure to guide their calculations. My second comment is regarding previous discussions about SB 261, inclusion of scope 1, 2, and 3 emissions. Companies that we are speaking with are nervous about including scope 1, 2, and 3 in 261 if it's not yet assured, knowing they'll be publishing assured emissions in 253. Also, for this year's example, it is highly likely that it is highly unlikely fiscal year 2025 calculations would already be ready for January 1. So if they do have emissions that are material to their financial risk disclosures as part of SB 261, would it make sense for them to include prior year emissions that are not assured? Thank you.
Thank you. I'll just say for 261, I want to make sure we're not getting 253 and 261 crosswise. Of course, would refer back to TCFD and IFRS guidance there in terms of including scope 1, 2, and 3 emissions where it's material.
Okay. Moving on to the next commenter, Renata Vidovic, please unmute yourself and present your comment. Renata, are you still connected? Are you hearing us? Please unmute yourself. Okay, I'm going to move on to Teresa Davies next in the queue. Please unmute yourself and deliver your comment.
Hello, this is Teresa Davies. I'm a sustainability reporting practitioner, not representing on behalf of my company. First, just wanted to thank you again for the work that went into this webinar today and for addressing our questions and comments. I have a question pertaining back to the limited assurance requirement for 253. Earlier in the webinar, you had shared a list of potential standards for verifiers to follow. And I just wanted to clarify if there is an intention at some point to only allow specific standards for limited assurance verification, specifically for this first year. And then I guess more specifically, if you can clarify if verifiers would be required to adhere to ISAE 3410, or if adherence to ISAE 3000 and or ISO 14064-3 is acceptable, as many reputable verifiers currently use the latter. And as a follow-up comment to that, it would be appreciated to have clearly stated flexibility around verification standards due to companies' unique emissions inventory needs. Thank you so much.
That's very helpful. If you wouldn't mind also submitting some written comments, we'd love to take that into account in our thinking.
Thank you. Our next commenter will be Brandon Gilligan. Brandon, please unmute yourself and proceed. Brandon, if you're speaking, you're on mute. Okay, I'm gonna move on to the next commenter on the list, Natalie Clark. The floor is yours. Please unmute yourself and give your comment.
Hi, this is Natalie. Can y'all hear me?
Yes.
Okay, perfect. I just want to make a comment on the note of using the Secretary of State's business entity search as the function to determine which entities are going to be within the scope of this regulation. The site currently says that it does not include limited liability partnerships in that function, so that could just create some confusion for those entities of whether or not they are included in the scope of these regulations.
Thank you, Natalie. Very, very helpful.
Our next commenter will be Neville Shah. Neville, please unmute yourself and proceed.
Hi, everyone. I'll start by saying thank you very much for taking my question after over 3 hours for this workshop. I missed my lunch break, but I'm still excited to be here. And I promise to keep it short and hopefully sweet. I'm with Amcor Technology, a global company based in the semiconductor industry with our headquarters in Arizona. And we have 2 small sales offices in California, which I believe would be subject to the current definition of doing business in California. So I'll limit this to 2 questions. Earlier in the Q&A, I heard that CDP reporting might be acceptable for SB 261, and I just wanted to confirm that if that would be acceptable. As I understand that CDP does align with the TCFD and IFRS as to disclosures and includes the 4 pillars for climate risk disclosure. So that's one question. And the other question also is, given we have very small presence in California, like I mentioned, we only have 2 small sales offices. We have a very small carbon footprint in California, and majority of our emissions comes from our operations outside the US. Has there been any sort of consideration for exemption if companies have very small carbon footprint in California, or any sort of guidance on if we still need to disclose our reporting for California, even though there's very small presence? Any guidance on that would be helpful. So thank you again for the opportunity, and I look forward to continuing our engagement.
Yeah, thanks for those questions. I think staff mentioned earlier, if there are other exemptions they should be looking at, please provide that in writing and the rationale as to whether the statute allows for it or if there's another compelling reason why there should be an exemption. In terms of the CDP reporting, the statutes mention standards. They don't mention a program or a platform. They mention the standards. So if you believe that those standards are accurately reflected in an organization like CDP, and you feel like that is going to meet the guidance that the staff puts out, it's fine to submit that to CARB. But we are not evaluating CDP, and we are not referencing CDP because the statutes do not reference an organization. Thank you.
Okay, our next commenter will be Shweta Aurora. Shweta, please unmute yourself. Shweta, if you're speaking, we cannot hear you. Please unmute yourself and give your comment. Okay, I'm going to move on to the next person in queue, Matthew Weiser. Matthew, please unmute yourself and give your comment.
Hi there, can everybody hear me?
Yes.
So thank you so much for the time and the information that you provided during this workshop. My name is Matt Weiser, and I'm here representing Silver Regulatory Associates. I have one very quick clarification question with respect to the updated proposed definition for doing business in California. In both the FAQ and the previous workshop slides, there were 4 conditions based off of the revenue and tax code definition provided in section 23101B that could trigger the AND test for doing business in California, that being commercially domiciled, sales, real property, or compensation. In the slides that were part of this workshop and what we've talked about today, the definition only included the organization being organized or commercially domiciled in the state or sales. I just want to confirm, are the criteria related to real property or compensation paid within California no longer included as a condition which could trigger this doing business in California definition under the current working definition? That's all I have. Thank you.
Thanks, Matthew. Yeah, I appreciate you bringing up that sub-article. Yeah, essentially staff consider that of property or that salary threshold to be too low for the purposes of this regulation. So we're not really
Jordan Zoom was threatening to crash and finally has.
Yeah.
Pedro, do you want to jump in?
Sure. Yeah, I just to complete Jordan's thought, I think he was saying that those thresholds for those last 2 criteria were too low, and I think most companies would already be captured by the first 2 anyway, so we felt like it was unnecessary to include those last 2.
I'll just say we're still taking public comment on whether or not we're getting our proposals right. We're looking to batten down the hatches on these regulatory definitions, ASAP, as we're going to the board pretty shortly.
Great. Our next commenter will be Paige Schulter. Paige, please go ahead, unmute yourself and proceed.
Hello, thanks for doing this webinar. The 261 bill states that reports must be posted on the company's own internet website. Can a company meet this requirement by creating a dedicated microsite to host the report, or must it be posted directly on the main corporate website? And then two, if a microsite is acceptable, does it have to be clearly linked to the main corporate website of the company?
Thank you so much. Yes, thanks for giving me the opportunity to clarify the 261 requirements. So the letter of the law and statute is that the company needs to post it on its own website by Jan 1. We are implementing that by also requiring companies to give us that direct link to that report so that CARB can serve as a general repository for all of those website links so that folks who are interested in reviewing all those reports can just come to the CARB website. So this will help with public transparency.
Okay, our next commenter will be Ivor O'Neill. Ivor, please go ahead and unmute yourself.
Hi, good afternoon, everyone. Ivor O'Neill, KPMG. Not representing clients, but a couple of quick questions for you. Number one, can you reconfirm that insurance companies are not subject to 261? Just to reconfirm that piece of things, because they already subsequently report to California under a different rule. And the second one is, given the fact that doing business in California is being confirmed in December, is there an argument that there's undue pressure on companies to be able to file 261 by the 1st of January, given there's so short of time on that definition being finalized and being put out to the public knowledge? Thank you.
So the terms of the 261 exemption for insurance companies, that exists in statute. I think your other question is about the January 1, 2026 deadline for 261 and whether or not there's opportunity to move that. No, that's currently set in law.
Our next commenter will be Deborah Shalek. Deborah, please unmute yourself and proceed.
Thank you. First of all, I just want to thank everyone for being here and providing such helpful guidance. My name is Deborah Shalek, and I am here for questions on a public reporting consumer products corporation headquartered in Massachusetts. My questions, two questions, are related to the SB 261. So in determination of the fiscal year threshold versus the reporting, I just want to understand and receive confirmation if the threshold determination is for the prior fiscal year of 2025, because financial results will not be available and submitted until after January 1, 2026. And my second question is related to the climate-related risk reporting. If companies are completing a double materiality assessment in the good faith communication, could that be used? Not looking at the guidance yet, and making sure that in that reporting that we would just basically include that in a type of website, even though we don't have a sustainability website. Thank you.
I'll turn this over to Haynes in a second, but yes, yes, if you post the 261 document on your company's website and then give us the link to that report on your website, you'll have filled the requirements for posting.
And in regards to determination of the revenue threshold, you're correct that for the January 1st, 2026 reporting deadline, the prior fiscal year would be fiscal year 25, in which case that would be the determination for covered entities under 261.
Okay, our next commenter will be Divya Agrawal. Divya, please go ahead and unmute yourself and proceed with your comment.
Thank you, and I appreciate maybe being the last person to ask a question. I'm Divya Agrawal. I'm a Trinity Consultants. I don't want to repeat some of the questions I already had that others raised in some fashion or the other. My only follow-up clarification question was if we could get some clarity around what the covered and reporting entities are for the revenue threshold defined in 261 and 253. My specific question there was whether applicability as it relates to revenue gross receipts is set at the parent company level where consolidated financial statements are made. Now, sub question to that was, what if the parent company is residing outside of the United States? So yeah, that was my question.
In terms of applicability, statute defines applicability of 253 and 261 as U.S.-based businesses doing business in California, meaning different revenue thresholds. Reporting at the parent level is allowable.
Okay, our next commenter is Natasha Da Silva. Natasha, please unmute yourself and proceed.
Hello, can you hear me?
Yes, we can hear you.
Great, thank you. Thank you all. I appreciate you squeezing me in at 1 p.m. I am with DNV. We are a decarbonization and sustainability services firm, including providing accredited GHG verification services. And I had two questions which you may not have the answer for at this time, but I just wanted to put it out there. One is related to conflict of interest in particular as it relates to the 253 and 261. Can a services provider provide both climate risk support as well as assurance? They're not necessarily in conflict, but since we are talking about perception, I wanted to kind of ask that question and gauge whether you had a response to that. And the second one is related to whether or not you will be providing confirmation on how market-based scope 2 emissions report, what the reporting requirements will be, and provide specific calculation requirements regarding the market-based method approach. We get a lot of questions around this, and a lot of them are regional. And now with mandatory reporting, that sort of ups the ante a little bit. So thank you. Thank you again, and thank you for this webinar.
Thanks, Natasha. As far as templates for reporting go, we're going to be putting those out by the end of September. Thank you.
Okay, and we are down to just the last small handful of commenters, so we will go ahead and knock these out and let everybody get on their way. Next commenter is John Grande. Please unmute yourself and deliver your comment, John.
My name is John. I work for Robertet. We're a fragrance and flavor company on the East Coast with a parent company based out of France. The one question I wanted to approach you guys with, and I do apologize if it's already been answered. Like I said, I'm on the East Coast over here. I did have to step away for lunch for a second. Will SB 261 recognize equivalency with other reporting standards like the European CSRD or ESRS? Our current CSRD report includes a lot of climate-related information, which may mostly but not fully be aligned with TCFD. Thank you.
Thanks, John. Let me just take the opportunity to say West Coast, best coast. That's what you get for hanging on till the bitter end. Okay, so for 261, what is allowable in terms of the voluntary reporting frameworks are outlined by legislation. So TCFD 2017 or subsequent, IFRS, and then kind of a third catch-all bucket. We're also putting out, as part of this workshop, minimum CARB standards for this initial reporting requirement. So we're really focused on these kind of these three buckets of standards, as well as the minimum thresholds that CARB is putting out. So I would use those as your primary reference for whether or not these climate-related financial risk reports kind of meet the threshold for the Jan 1 deadline.
All right, our next commenter is Dina Magner. Dina, please go ahead and unmute yourself and proceed with your comment.
Hi there. Probably easiest question of the day, and you may have covered it already because I joined late, but will the slides that you shared at the beginning of the call be shared?
Yes, they're posted on our meetings and workshops page right now.
Okay, great. Thank you.
So Dina, hero to us all.
Love that question. Okay, our next speaker, our next commenter will be Amanda Mesluk. Amanda, please unmute yourself and proceed with the comment. Amanda, let us know if you're still with us.
Hi, sorry.
Yes.
Thank you so much. I work for PCL Construction as their Sustainability and Compliance Manager. I have a quick question around SB 261, specifically around metrics and targets. I understand that the report is to be published on the corporate website. I think there's a significant risk requesting this report prior to the GHG inventory in June in terms of scope 1 and scope 2, as metrics and targets haven't gone through a rigorous review internally. They haven't had that external review. So my question is just to clarify, will you be compliant if you do not include metrics? So if you decide to follow the standard like TCFD report outline, and you focus on the governance, the strategy, the risk management, but you do not include quantitative metrics and targets with the idea that in subsequent years they'll be included, is that appropriate? And again, I just want to connect the sense that you're asking really, really large companies to report information that hasn't gone through an internal or an external review. So it actually creates some risk from that investor stakeholder perspective when it hasn't gone through that assurance lens. So can you answer that for me?
Yeah, I think we might be talking about a couple of different things here. So, as part of the draft minimum guidance that we've put out and are looking for comment on, we are still asking that companies disclose metrics and targets that are used to assess and manage relevant climate-related risks and opportunities where that information is material. So, quite frankly, following the TCFD 2017 guidance quite closely there. Where we're trying to give some flexibility is on this question around scope 1, 2, and 3. We've definitely heard from companies, particularly those that are, getting started or doing a climate-related financial risk report for the first time, that, reporting scope 1, 2, and 3, as part of this Jan 1, 2026 deadline is not necessarily feasible. So one of the things we're proposing as part of our draft guidance is to not require that as part of this initial Jan 1, 2026 reporting, and are seeking feedback on whether or not that's the right approach.
All right. And for our final comment of the day, Giles Wozniak, please unmute yourself and proceed with your comment.
Hi, this is Giles Wozniak with KPMG. My question's related to 261. I don't believe we've seen CARB release any materials that have explicitly mentioned opportunities until the slides that were released yesterday. So just wanted to confirm, will it be required to disclose opportunities as part of 261?
As part of the CARB draft minimum guidance, we're looking to try to put kind of minimum expectations out there and are seeking feedback on whether or not this draft minimum guidance seems appropriate. I will say one thing that has been out there for quite some time is the legislative language itself, which does point to TCFD 2017, IFRS, and a third bucket of options, which includes opportunity language, embedded in those frameworks as well. Well, thank you to all, many hundred of you that stuck with us until the end, and thank you for all of you who stayed on to ask questions for quite some time. I really appreciate it. Really want to emphasize that stakeholder input is really critical, as you've heard today, to shaping this program. These rules are all about transparency, and we need to have transparency in the development process as well. As noted, we've opened a public docket for written comment. A lot of great themes and ideas came up today, and having those in written comment will be helpful as well. That public docket will be open for 3 weeks. I'll just note, if you haven't already, please sign up for our listserv to stay engaged and be notified of any future public workshops and updates. Regardless of the docket period, lots of opportunities to work with us. If you have questions or comments, you can also please feel free to contact us at climatedisclosure@arb.ca.gov. Again, happy to meet with folks. Just keep in mind that given the number of potential reporting entities, thousands, we may have to book out a little, so really appreciate your patience. I'll just also state that we use our email to also push information out. So any and all input that's received via email will also be posted to our public docket. So with that, I want to thank you all very much for being part of our second workshop and looking forward to continuing to work with you. Thank you all.